Good morning, everyone. Good morning. Are you okay? God is good, and all the time. I hope you've networked enough. I've added you more time, but you'll still have time to network in the course of the day. As we wait for the other delegates to join us, we'd like to start our program because, as you realize from the program that you have, we are a bit late, but I'm sure we'll still recover that time as the days goes by. So right now, I'd like us to start with an opening prayer. But before that, kindly let's all rise for the national anthem. And as we do that, and Kent, kindly be ready to start for us with the word of prayer. So if we can get the national anthem. Washington. Thank you so much. At this juncture, I'd like to invite Kent. Kindly let's remain standing. There's no way we can stand for our national anthem and sit down for prayers. Sindio? Yeah. So, Kent, karibu.
Let's bow our heads for a word of prayer. Father and our living God, we come before you this day. We want to say thank you for everything that you've done unto us, O Father Lord. Thank you for the gift of life. We do not take it for granted. Lord, I pray for each and every person who is present, O Father Lord. I pray that you may give them grace and uplift them. For those
All right, thank you so much. Kindly, we may remain seated. You may sit, have a seat. Now, before we start, I would like you to turn to 5 people. Kindly shake their hand, know their name, tell them, welcome to StunnerBiz Season 4. I can't hear you. A warm handshake. Welcome to StunnerBiz Season 4. You can walk around the room. Make sure you say hi to around 5 people. Salimia na mjue majina zake. Around 5 people.
Welcome to StunnerBiz.
Around 5 people right now. So if I call you here randomly, you tell me the names of 5 people, yes? And not from your organization. Okay. You may take your seats, kindly. At this juncture, I'd like to invite Mr. George Kishuki, who is the managing editor, Biashara Leo magazine, to give us his welcome remarks. So, Mr. George, karibu sana. Let's clap for him as he comes to the stage, kindly.
So, karibuni wananchi. I beg for your indulgence. I know you have lost a bit of time in our program, but kindly bear with us. So, karibuni sana. We are here to celebrate Conquer and Connect as with united with the mantra of our brand, StunnerBiz. A vision needs a man of standard staff. That is what Shakespeare says in the play Julius Caesar. And the same applies also to business and entrepreneurship. There are a lot of ups and downs. So we should all be made of standard staff. But I believe each and everyone in this room is made of standard staff. That both is standard and kindly don't leave. There's a lot of good things that are going to happen. Thank you.
Let's give him another applause, kindly. A better one. Thank you. At this point, I would like to acknowledge our partners who worked with us this journey. So when I mention you, I know we are going to get, I'm going to give you some time to come and maybe speak and tell us what the organization is all about. But right now, when I mention you, kindly where you are, you may stand and wave to the audience. We have Steamer Sako. Are you in the house? Steamer Sako. Let's clap for them. We have Ahead. Are you in the room? Let's clap for them. You have Postbank. Are you around? She's there. Let's clap for her. Ascension Investments. Okay, I think they are still on their way. Kopo, are you in the house? Asante sana, let's clap for her. We have Anaweza Sako, are you in the house? Wow, let's clap for them as well. We have Mentor Sako, are you in the house? Good, let's clap for them. We have Tai Sako. Karibuni sana, thank you so much. Meliora, are you in the house? Good, thank you so much. Musoni, are you in the house? Musoni, thank you, that's a great team. We have Caritas Microfinance. Good, big team, asanteni sana. We also have United Winners. Let's clap for him. We have Smith Microfinance. Thank you so much. Let's clap for him. We also have Gelly B. Let's clap for her. We have Hand in Hand. Are you in the house? Santeni sana. We also have GDC Sako. I'm sure they are all karibu sana. All umeshafika, asante sana. We have Amphi Kenya. Let's clap for them. Asante sana, Madam Karo. Good to see you. And we are also expecting more of our partners who will be joining us, the likes of Ascension Investments and also Neptune. Karibuni sana and feel welcome. today is a day to learn, today is a day to network, today is a day to connect. So one thing I can assure you, you're not going to live here the same way that you came. I believe in learning, and learning is a continuous process. That's very true, kabisa. So at this juncture, as we start our program, I'd like to invite our first speaker for the day, who will give a keynote address, and that's none other than Dr. Gamaliel Hassan, who is the Chief Executive Officer, Stima Sacco, as he discusses the topic from legacy systems to digital ecosystems, that is navigating the challenges faced by SACCOs in their digitalization journey. And Washington, kindly, we'd like to get the profile so that our audience can relate with Dr. Gamaliel Hassan. And I remember the last StunnerBiz, he was also one of our speakers, and he made a really great impact. So one thing I can assure you is you're going to really learn a lot. You can get his profile. For those who might be meeting him for the first time, Dr. Gamaliel Hassan, he holds a PhD and an MBA in Strategic Management, a BA in Economics, and is also a certified public accountant, that's a CPAK, and certified public secretary, CPSK, in good standing. So at this juncture, the rest I'm sure it has been projected, you will read as we get to know him more. Mr. Dr. Gamaliel, karibu sana. Welcome. Let's clap for him as he joins us in the stage. Welcome, sir. Good to see you.
So, good morning, everyone. Good morning once again.
Good morning.
Lovely being here for another season. I think I was here last year. The engagements were very nice, learned quite a lot. I will try and keep my discussion short. There's a small, did you get it? Do I aim and click? So I'll try and keep this short. Simply because I'm also looking at the time and I know most of you came very early in the morning. And I also need to save some time for my other speakers who I'm also aware also have a very busy schedule. So I was asked today to discuss with you around legacy systems to digital ecosystems, and I'm speaking from a perspective of the SACCO sector. And I'm very happy, in particular because as the introductions are being done, I could say my brothers and sisters from the SACCO sector in the house. So I do hope that this will relate to you. And one of the key things that you're looking at is the aspect of digital transformation, on whether it is a technological project or better, we look at it as being a strategic business transformation enabled by technology. And I hope by the time that I'm done with this presentation, then we should be able to demonstrate that. Alright, so I am clicking and I see no more. You can test this. So let me give you a bit of background around the SACCO sector. The data I have with you in front there is from the SACCO Society's report. You happy with that? Okay, cool. I think we're good. Thank you. Thank you so much. So before you there is from the SACCO Society's regulatory report. It's a report that is done annually. The one, unfortunately for us in the SACCO sector, the report always comes around October. So the one for 2025, we'll have to wait until October to get the data. But I've also combined some data from the Kenya National Bureau of Statistics so that you can also be able to have a good background. So according to KNBS, there are more than 13,000 SACCOs in Kenya in total. However, the ones that are regulated by SASRA is the SACCO Society's Regulatory Authority, are only 355. If you were to do a quick mathematics, you'll see that is a very small percentage. Out of the 355 regulated SACCOs in Kenya, 178 are what you call deposit-taking SACCOs, pretty much do all the banking that needs to be done, with the exception of not doing foreign exchange and having access to the national payment system. But everything a bank does, then the DTSs do, and of course you have another 177 non-DTSs that are also regulated by SASRA. For context purposes, for those who are not in the SACCO sector, SASRA is the equivalent of CPK to the banking sector. That is what SASRA is to those 355 SACCOs. Importantly, a very important statistic is around the fact that although there are 13,000 SACCOs in Kenya, give or take, these 355 SACCOs control more than 85% of the total asset base. So the 2080 rule does apply there. Our sector has more than 1 trillion shillings in total assets, and like I've said, this is as per the close of 2024, and as the numbers of 2025 come, it will showcase a bigger number. Our loan portfolio cumulatively, we have given more than 845 billion shillings in loans, more than 749 billion in member deposits, and most importantly for us in the SACCO sector, we have more than 7.4 million people who are our members. Again, for comparative purposes, the banking sector has about 14 million people as members. The difference again is where we play in the pyramid. So for the SACCO sector, predominantly we will be at the base of the pyramid. For those mostly who are called unbanked, that is the kind of segment that we'll be looking at. Why digital transformation can no longer wait for us? Our member expectations has been changing rapidly. We have a lot of key drivers, the first one being mobile-first financial services. As you can see, every person here in the room has a mobile phone. Kenya as a country is well renowned as being the leader in terms of the mobile platform. Think about M-Pesa in terms of the mass mobile-first money transfer system. We're the first one in the world to actually do that. So we are actually leading in that. And SACCO sector is not existing here. We exist in a country that is mobile first. And I think you also read information to do with the fact that we, if I'm not wrong, I read this somewhere, I don't know if it's a good or a bad thing, but Kenyans are #1 in social media usage. You had something like that in terms of percentage. And of course we all know KOT, you know them? Yeah, I can see some of you are there as well. So mobile first financial services is very critical for any person in Kenya and of course in the SACCO sector. We have a lot of competition coming in from the banking sector and the fintech. Every other day, CPK is registering new and more individuals who are running fintechs. We do have growing transactional volumes. The bigger that we're becoming, the more the transactional volumes are coming on board. Cybersecurity is a major issue in Kenya. The statistics indicate that Kenya alone in 1 quarter, we get more than 2.5 billion hacking attempts. 2.5 billion hacking attempts. So SACCO alone, I think we receive average 6,000 hacking attempts every month, every other month. So even if you took up that, divide by 31, please do that for me. Take 6,000 and divide by 31. What do you get? Somebody can shout for me the answer. How many? Ooh, louder. 200 and what? 193. So in a day, it doesn't do a number of hacking attempts we receive. 193 divided by 24. How to check per hour? 8. So every hour, we get 8 hacking attempts. And I'm sure it is true for any other financial institution that is there. So, number 3, increasing the regulatory expectation. Because of what I've just mentioned, obviously the regulators expect you to do more in order to protect member funds. There's demand for real-time services. Nobody is waiting for your branch to open or to close. They want to have their services in the comfort of their homes, in the comfort of their bedrooms. And of course, there's also need for data-driven decision-making. And we do believe that the future competitiveness of SACCOs therefore depends on how effectively we embrace digital technology. I'd like to give you just a roadmap where we have been as Team SACCO. We began in 1974. By the year 2002, we began our banking services. In the year 2010, we opened our common bond. We are the first SACCO to be regulated by SASRA. In 2014, we opened diaspora banking. Our loan portfolio was 2.4 billion shillings just from the diaspora. Then come 2019, we opened an insurance agency. We do premiums of 630 million shillings annually in terms of the insurance premiums. We opened Sharia banking in 2021, the first conventional SACCO in Kenya to do Sharia banking. We are in affordable housing. We are one of the pioneers of Kenya Mortgage Finance Company, whereby we are able to lend affordable mortgages at a digit of less than 2 digits, so 9% per annum. Our portfolio is about 1.4 billion. We are now 52 years of age, and as of this year, we have now moved into brokerage. So we started off as an insurance agency, and we now moved into a brokerage. And none of this would have been done without the adoption of technology. And I hope I'll be able again to demonstrate that to you. But also importantly, as apart from being a CEO at Stunner SACCO, I have 2 other hats that probably I should have also informed you of. Number one, I chair and see some of my governance members in the room. I sit as a chairperson of the Credit Information Sharing Association of Kenya. It's an association of banks, SACCOs, MFIs, CRBs, mobile providers, fintechs, you name them, government institutions including KDIC and the Higher Education Loans Board. And what we attempt to do there is to try and look at the credit, the macroeconomic credit environment in Kenya, and then see how we can be able to work together. Because the pie in Kenya is so big, it cannot be done by just one person, or one institution, or one sector. We need to come together so that we can be able to offer affordable credit to everyone. But importantly, for the purpose of this presentation, I've also sat in as a committee of expert member appointed by the CS in charge of cooperatives. That's Honorable FCP Weekly for Paranya. And we were given a mandate insofar as this committee is concerned. We were asked to do a couple of things. Number one was to review the SACCO Societies Act. We were meant to align legislation that was coming from the cabinet to do with things to do like deposit guarantee fund, central liquidity facility. We were asked to benchmark globally with SACCOs and credit union models across the world. And maybe for context purposes, the largest credit union, the largest SACCO in the world, has an asset base of 27 trillion Kenyan shillings. Just think what the largest bank in Kenya has an asset base. So that is what we were requested to benchmark with. We also asked to evaluate the administrative structures and of course to recommend reforms. And for me, it came with 6 key reform pillars, which I think are very pertinent to the discussion we're having today. The first pillar, we came with a recommendation to regulate, to have regulatory harmonization. We found that, as I mentioned before, there are more than 13,000 SACCOs in Kenya. Only 355 are regulated. If you think of the disaster that happened around Cusco, for those who might be aware of that, it happened simply because that was an unregulated SACCO doing our business. So the reforms we've come up with is that to say that every SACCO in Kenya needs to be regulated. Not just the 355, but 12,000 plus. And one of the key recommendations and key implementations was that immediately after that, all SACCOs in Kenya were requested to register. And I think from the data that I've so far received, I think only less than 3,000 SACCOs have actually registered out of 13,000. So it tells you that we have a lot of SACCOs that are actually unregistered. Number 2 was the deposit guarantee fund. This is very simple. In the banking sector, if a bank does collapse, then KDIC pays up to 500,000 shillings per account. We don't have that in the SACCO sector. So it is one of the other key recommendations that we came up with, that the SACCO sector does indeed have to have its own deposit guarantee fund mechanism to protect against loss in case of any SACCO collapse. Number 3, central liquidity facility. This is a very simple one. You have SACCOs with a lot of liquidity and SACCOs with less liquidity. Stima, as an example, has a liquidity ratio of more than 105%. Statutorily, you need to only have 15%. But the problem is you could have one circle with too much liquidity and the other with none, but there's no mechanism for them to lend on a day-to-day basis. So you need, the circle still goes to a bank. From a bank they're able to borrow at a very expensive rate, yet you'll be able to borrow from another circle at a very low rate, similar to what the banking sector does. We also have a lot of governance reforms we've come up with, including strengthening accountability and leadership standards, shared services, very critical for us. We think as a sector, we can be able to have a sector-wide infrastructure and efficiencies that can enable us to do things together. For example, today you'd find many circles are using banking halls for their members, so that because you do not have adequate branches, you go to a bank, and from that bank, you can be able to use their branches to deposit or withdraw money. So we're saying, why isn't that possible for one circle to do in another circle? If a circle has more branches in a particular area and you have less in the other area, why can't we commingle the same way that we commingle with the banking sector? Similarly, today we use infrastructure for the banks. We use ATM facilities. We are doing RTGs, EFTs, and we're using the banking sector to do that. We do think that through a shared platform that we in the circle sector can be able to connect directly to the national payment system and also be able to do that for our own members. And lastly is around the aspect of stabilization protection scheme, whereby we're saying before circles collapse, before they become highly distressed, then we do have a facility that can be able to support them technically in terms of early intervention. So the challenge of legacy systems that we looked at were very many, even as we did that report to His Excellency the President. Many circles we realized continue to operate in a fragmented, and we do have aging technology environment, and the key challenges is what I've listed there. We have what we call siloed systems, so systems that don't speak to one another. We have manual processes, quite a lot of them. We duplicate a lot of data, so one system has data, you go to another system, carries the same data. Limited integration, again, similar to siloing. These systems are not talking to one another. Very slow reporting cycles, and most importantly for us is high operating costs. So if you have to look at things like annual maintenance contracts, because we have so many siloed systems, it becomes very expensive for circles to actually pay for these systems. The consequences of this, a couple of them. Number one, we end up having reduced efficiency. Our members complain more, they have very poor member experience. You cannot scale up, you cannot expand in terms of the business you do have. It does increase our operational risk. And something very important is around transactional latency. That our systems become very, very slow and we are unable to serve more and more of our members. A very good analogy is asking the whole of Nairobi to vacate in one day and every person to use the expressway. You can imagine what will happen. So there'll be a lag behind it. And that's basically what is happening to our system. So legacy systems are no longer merely an IT issue. We also consider them to be a business challenge. In terms of cybersecurity, and I think I mentioned a bit of this at the beginning, and trust in the digital era, we do have a lot of emerging risks. Cyber risks and cyber attacks are the biggest risks that are there. So if you're a circle sitting here today, one of the key that you need to have is a protection of your systems through either having a security operations center, the same way banks actually do that, and if not, you go under what is called an umbrella. And I'm not here to say on behalf of any telco, but I'll tell you, Safaricom is a very good example. They offer you an umbrella, it's a cap, whereby they're able to monitor on a day-to-day basis what happens in your systems. If you have to look at our analysis of our own data, we are finding that a lot of the attacks that happen are not even localized. Some of them, most of them are actually international attacks from the US, from Europe, from Asia, Russia, all that side, from North Korea. You're seeing people looking at circles as being a convenient place to actually attack if you do not have the right system. But if you do, you can be able to monitor, you can also be able to mitigate. Other key challenges we have is around fraud. Identity theft is a big issue, especially in Kenya. Many instances we find identity theft with regards to your SIM card, whereby the SIM card is actually changed and converted to somebody else, and basically once they do that, they do have access to your bank accounts. Of course, there are also data breaches and also system disruptions. So all of those are the key things that we are seeing as being a threat around cybersecurity. What do you need to do so that you can be able to respond to cybersecurity? The first one is what I was mentioning, real-time monitoring. Having end-to-end encryption becomes very critical. More, better, strong access controls. Carrying out vulnerability testing. In StunnerBiz, we do have hackers, our own, they're called ethical hackers. So we pay people to hackers ethically, so that they can be able to tell us what vulnerabilities are there before the real hacker actually lands. These are people paid, and they're called ethical hackers, and you can hire them and keep them as part and parcel of your employees. Staff awareness and training becomes very critical, regardless of the level of systems you have, regardless of whether you have an umbrella, a SOC team. Your weakest link is people. So if somebody is given a flash disk and told, go take this flash disk and put it inside a laptop, and they do it, that's a problem. What if they get an email, a phishing email, whereby you're told, click here, and you click on it, or click here and you win, you know those kind of emails that come out. That becomes the greatest point of weakness for any institution, and therefore staff awareness and training becomes critical to something that we undertake to do on a day-to-day basis. So the greatest cyber risk is not technology failure. It is what we call trust failure. And a simple breach can undermine confidence that you build over decades. So I spoke about unscaling and unlocking scale through shared services, and there are many opportunities for we in the SACCO sector. The first one is around shared core banking platforms. A core banking system in Kenya proper will cost anywhere between 500 million shillings and probably 2 billion for one SACCO. So if you're to count, we're 355 of us, and if you're to count each of us is spending 1 billion shillings each, or even 500 million bob each, that is quite a large sum of money. Again, when you go outside the country to Canada and the US, they form what is called QSOs, the Credit Union Service Operators, which is what is in the bill actually right now before Parliament, whereby the SACCOs can form their own shared services platform. This shared services platform will mean that instead of StunnerBiz spending 1 billion, police 1 billion, Mwalimu another 1 billion, every other person is spending 1 billion, we can all come together using one vehicle, and we have our own shared core banking platform. Similarly, it will enable us to do things like cybersecurity infrastructure. We can have compliance services. It will enable us to have inter-SACCO payment, I already mentioned that. It can enable us to also have inter-SACCO lending, and most importantly, and sometimes what makes other sectors uncomfortable with the SACCO sector is our demand to have access to the national payment system. We do think that SACCOs have come of age. You do not need to have an intermediary bank to do an RTGS or an EFT for you. You can be able to do that directly. If today I need to send money directly from my SACCO to another SACCO, that should be done seamlessly without having a bank as an intermediary. So we do think that using those shared services platform, and again, as I've mentioned in legislation, we've already taken into this account, and again, if you have to look at the billing before Parliament, it does talk about having a shared services platform. The benefits that we think you're going to accrue, number one is lower operating costs. Like I've mentioned, there are many middlemen. You'd be surprised we pay up to 70% of the revenue that is being collected to a middleman. So we're saying if a SACCO does that directly, then it does not mean then you need a middleman to do that. It will mean you can have faster innovation of our products and our services. It will mean more improved compliance, greater resilience, and most importantly for us, it will mean a better member experience. We do believe our model as a cooperative works. We're not going to change it. StunnerBiz does not need to become a bank. We don't, and neither do any of the SACCOs here. As you are, and as we have seen in more developed economies, and again I mentioned in Canada, in the US, in Australia, if you go to the UK, SACCOs are large institutions, and they're able to do all of these things that I've talked about. So our model is uniquely positioned to benefit from this shared digital infrastructure, as one of our key pillars is actually cooperating amongst cooperatives. So what is your digital journey roadmap? I will break this down into 4 phases. The first phase, you need to have core modernization and database cleanup. You're only as good as your data. If your data is dead, is dirty, you'll not go far. But if you have clean data, data that speaks to you, you can then be able to modernize your core. Your core, which is important, and maybe, and I don't want to sound too technical, you have an engine. The main system is the core system. And everything else is merely a plugin. So if you want mobile services, you can plug into the core. If you want digital internet banking, you can plug it there. If you want ATM services, you can plug it there. If you want national payment system services, you plug it there. Anything that you can potentially dream of, you plug into the core. So important, before we talk about all of these things with technology and advancing Masakos, start with the core. How good is that core system that you actually have? And therefore, that is what we call core modernization. Number 2, once you have the core, then you use API integration. API enables you now to connect all of these other systems I've talked about into the core. So, and of course you now put the payment gateways into the API integration. Once you're done with that, you can think about automation. One of the biggest headaches we see in the SACCO sector is that a lot of our processes are manual. So if you can move away from the manual processing, automating more loans into the mobile platform, more into internet banking, then you can be able to really shift a lot of the practices that you're doing and let your appraisers, in terms of credit appraisers, appraise the more longer term loans, like mortgages, like business loans, like SME loans, but not the normal day-to-day loans. And of course, because we use a guarantee system, majority of us, you can also look at ways where you can automate that guarantee cycle. It's only then I would advise you consider full cloud scale and of course automated lending. The priority strategic action items, I've listed 5 for you. Number 1, you need to strengthen your cybersecurity posture. I've mentioned there's a lot of risk in the SACCO sector, and not just the SACCO sector, in the financial sector, so you need to invest quite heavily around that. So you need to conduct structural risk assessment, and there are companies that do VAPTs, and those are vulnerability assessment and penetration tests. So you need to invest in protecting those frameworks. Again, I've talked about automating the core operations, I'm not repeating that. You need to support shared platforms. Currently in Kenya, there's one organization called SACCO Central, and again, I'm not here to say any organization, but more than 72 SACCOs have come together to form a shared services platform. So you're part and parcel of that. Consider it so that you can have sector-wide participation insofar as shared platforms are concerned. You also need to build internal capacity. So you invest in digital skills and change management, and please note, this also becomes a risky area for us, and I see that quite a lot. The bigger we grow, the more attractive our staff are to the banking sector, to the telco sector. And that goes without saying. So you need to build a pool that regardless as people come and go, because you're not going to block career growth. If somebody today comes and tells me, I've got something better to do elsewhere, and I've been promoted to a managerial position, and I'm unable to give them that instead of them, you happily let them go. You're sad to see them go, but you're happy for their career growth. But it means for your SACCOs then, you need to continuously have a revolving door of individuals who are digitally inclined and digitally aware. And of course, strengthening governance. All this will not happen if your board does not understand the language of innovation, the language of digitization. So you need to find a way whereby both in terms of board and also in management that they're digitally informed, and they also have to be aware they can be accountable as well. My point there is digital transformation succeeds when technology, when people, and also when governance moves together. A very small case study was Team Masako in terms of what we've managed to do. These are our own numbers, so I share with you in the spirit of cooperating amongst cooperators. In 2023, our digital volume, we were doing 33.9 billion shillings in a year. In 2025, in terms of the digital transactions, they moved to 51.4p. That's a 51.5% surge in digital transaction, and importantly, in bold there, 93% of all our member operations is through the digital channels. We have branches, but members don't come to our branches. Our branches only account for 7% of the movement of transactional volume. And I'm sure if you go back and analyze, for any person who has moved to the digital platform, you might find that you're facing something similar, because I've seen the same for the banking sector as well. The outcome for that, for us, has been improved efficiency. We have had enhanced member convenience. We are reducing our transaction costs, so our bottom line looks way better. Our visibility is everywhere you go in the system of SACCO. We have greater scalability, meaning that we can do more. And we do believe that digital transformation has indeed delivered measurable value because it has been supported by leadership commitment and, of course, strategic investment. The future of SACCOs, as I wind up, the question for you is no longer whether SACCOs should digitalize. The question is whether we will digitalize fast enough to meet the expectation of the next generation of members. And you can see that with our Gen Zs. People are more demanding, they're more aware. Unlike in the past 10, 20 years ago, members and customers will be told, nowadays they tell you. So, as an institution and as SACCOs, we can be able to combine our cooperative values. And for instance, you know, we have 7 main cooperative principles. If you combine that with strong governance, you combine that with digital innovation, I do believe that this will define the future of member-owned finance in Africa. Those are my many remarks for the day. Thank you for having me. And if there is time, I will indeed take 1 or 2 questions, but I stand guided by the rapporteur. Thank you so much.
Let's clap for him. We will give time for 2 questions, 2 very quick questions. Kindly, anyone? Just raise your hand. Oh, Penina, you have a question.
Thank you very much, Dr. Bameli. I'm Penina from Menta SACCO, and I have a question. What are you doing about guarantorship, or rather, the young people no longer want to go around with forms being for by guarantors, something we have seen in Menta SACCO. I don't know whether it's the same with your case. Are you able to have members guarantee each other online, or what are you doing about it?
The second question, so that you can tackle both of them together.
Yeah, thank you, Dr. for that presentation. My name is Fidel from United Women SACCO. My question is on the reform pillars that you just highlighted, and one of them is the governance reforms. So my question is, under the governance reforms, considering the fact that SACCOs are member-driven and the leadership of the SACCOs come from the members, how are you going about the issue of bringing on board the young generation to be part of the leadership, the governance structure of the SACCOs, and the affirmative action, considering that these leaders are majorly elected by members? Thank you.
One last burning question. Okay, so.
Good morning. I'm Charity from Manisa SACCO. I believe this is a burning question. Considering the Skimmer SACCO being one of the best SACCOs in Kenya, we would like to know how are you dealing with the default cases? For the cases of the guarantorship, not the security loans, for the guarantorship, how are you dealing with the default?
Right, we'll take those 3 for now. So, Terry?
Yeah, thank you. Very good questions.
The very first question was around guarantors, and I'll tackle that with the last one as well. The guarantorship model is unique to the SACCO sector. It is not something we can wish away, but it only works best when you have a closed loop. What I mean is that you guarantee people you know. So for example, SACCOs that have a closed bond, you would find that their non-performing loan portfolio would be anywhere between 1 and 3% on average. Then SACCOs that have opened their common bonds have a higher NPL of say between 5 to 9%. I know SACCOs doing almost 18% in NPL, which is much closer to the banking sector. In the banking sector's NPL is around 16, in the SACCO sector on average is 8%. So for a SACCO next team that open its bond more than 2010, that's about 15 years ago, 16 years ago. We have moved slightly away from the guarantorship model. Not slightly. We still offer the guarantorship model, but we give a choice to our members not to look for guarantors. So two things that we've done. Number one, you can have self-guaranteed loans that you yourself, you guarantee yourself without having to look for anyone else. But for those, because we have more than 500 companies that bank with us, that have check-off with us, for those individual companies, we still leave the guarantorship model because it works. The guarantorship model is important because not every person will have a title, will have a car, will have collateral. So ideally, we should be saying let's go the collateral way, which you already do. So what we've done in Stigma is that we've given an option of you to use guarantorship or not to use guarantorship. So if you feel that, no, I do have a vehicle that I need to buy, we do have products that vehicle is the only security you need. You don't need any other security. No cash collateral, no deposits, no guarantee. But if I'm going today to DT to buy a car, or even buying a second-hand car and importing it, then up to probably 70% of the value of the car, between 50, no, it's between 70 to 90. We do 95% financing. I'm confusing that with the mortgage. We do up to 95% financing of that vehicle. So let me put that in context. It means that if a car is worth 2 million shillings, the member will only have to part 100,000 more, so that which is what the banks are actually doing. But we also know that that model cannot exist by itself, and hence we need to have a guarantorship model. So from the guarantorship end, we are still in this work in progress. The automation we talked about, very critical for us. But we looked at the cost-benefit analysis of that, and we've asked a lot of questions in terms of whether it's going to work. But the right way to go is to, in the future, look at how then you can automate the process. Because the problem of having an open bond is people do not know one another. But if you have one company, let's start with the original company being Kenya Power. If it's only Kenya Power, the people within Kenya Power know each other, they are able to guarantee. But immediately you move to other companies that we have. We do have KQ as an example, giving us a check-off. Those people of KQ do not know the people of Kenya Power. So it becomes a bit hard for you to have cross-pollination of guarantorship. And also guarantorship is very personalized. Remember, guarantorship means that you're taking over the liability of that facility if that facility goes wrong. So our way forward, therefore, to summarize, is very simple. We give multiple kind of products. We give self-guaranteed products. We also give collateral-based products, purely collateral-based products. And thirdly, we do give guarantorship. But on the guarantorship aspect, we also give a lot of awareness, a lot of education. So we consistently tell people, be careful. Do not guarantee somebody just because your form has been given to you. Do you know this person personally? There is a personal responsibility for a guarantor. And if you do not school your members around that, then that becomes a problem. So in a nutshell, that's basically what we are attempting to do. In terms of default cases, they do occur. But remember, as SACCOs, we are not very quick to sell your collateral. We always have a discussion with you. Can you have an element of restructuring? Is it an issue of reviewing the payments that you're making on a monthly basis. But for those hardcore defaulters, and they are always there, we do CRB listing. We actually do that. But we also the first circle to do both listing. We do positive and negative listing. I know most institutions in Kenya only list you for negative. We don't do that. We have something called positive and negative listing. So that if somebody comes to lend to a member of Stima Circle, they will find, if a bank is coming to lend to him, they will find already that this member has an existing facility. And that facility is either performing or not performing. So we don't hide that. We showcase to everyone that our member has already taken a facility. And that is important so that whoever else wants to give them a loan immediately becomes aware. If you do not do that, what normally happens in Kenya and for many circles is that your member might potentially go to a bank, borrow from a bank. What will happen to the check-off? The check-off leaves, isn't it? But if the bank is already aware, if the MFI is aware that this member already has a facility with your circle, they will not be able to do that. So that's another way that you can be able to protect yourself. Also importantly, like I mentioned, I do chair the CIS Kenya, and in that we have a tool called the validator tool. This validator tool is a tool that enables you to list on all of the 3 CRBs in Kenya. Another problem we have today as far as defaulters is concerned is that because of the cost of listing, sometimes you only choose one CRB. So using the validator tool, you can utilize the CIS Kenya validator tool to be able to list in all of the 3 CRBs and have the same information. And this information is not just for the circles, but can also apply to MFIs and also the banking sector that have also embraced it. The second one was around what the reforms that you've put in place. Now, that's tricky. The median age in Kenya, I think, is 19 or 20 years. In my circle, I think 31 years is the mean age, medium age. I'm amongst the 3% oldest in the circle, but I am in the minority. So what you've attempted to do, starting first from our own employees. Remember, your potential customers are getting younger and younger and younger every day. Today, your largest clientele is a Gen Z, most likely. The millennials are already in. The Gen X are already getting kitambo sana. But it is a Gen Zs that you're looking for. So if you're looking for a Gen Z to join your circle, who is serving that Gen Z? Is it me? Does that person look like me? Absolutely not. So you look for people that look like them, who speak their language, who walk their talk, talk their talk. Those are the people who can be able to understand one another. It is not going to be an old man like I am now, trying to convince a Gen Z to join Stima Circle. I will not be able to do that. But if he comes to the banking hall and sees a reflection of himself, then most likely they are able to join. So when you move now to the governance level, it is the same thing as well. If you can be able to empower your members, especially the younger members, I do have this strong belief that our role, specifically as circles, is to make the next millionaires. That is our role. Our role is not to look for people who are wealthy. Our role is to look for those people at the base of the pyramid, the younger individuals, grow them so that they can become the next millionaires. And as they grow and as they accumulate their wealth, then they do have a bigger say in the running of the circle itself. It is hard to put that in legislation. You're not going to force it to say you must have X number of people sitting in the board who are young. But remember, the Constitution of Kenya is very clear in terms of diversity. It talks about gender representation. So your board must be at least 1/3 of the same gender. You have to look of different genders. You need to look at people with disability. They also need to form part of the board, and also the younger people. But for me, it's not about bequeathing the younger people population in the board, but it is about empowering them so that they can now be able for themselves. And because at the end, circles are democratically controlled institutions. And remember how our boards are formed. Our boards are formed by election. And if you agree with my argument, the majority of our members being young, then it is them who can be able to decide and dictate who sits in the board. They can say, no, we want one of our own to actually be represented in that board. I hope I've been able to answer those questions. Thank you.
Wow, thank you so much, Daktari. He deserves a better handshake than that one. Thank you. Thank you so much. And I think for me, the point I'll take home is digital transformation happens when technology, people, and governance come together. Are we still together? All right, thank you so much, Daktari, for that presentation. There are some people who are asking me if they can be able to get the PowerPoint presentation. I believe that will be submitted if you didn't get the notes, so that will be submitted as well. At this juncture, because of time, I would like us to move on to our next speaker, but before we do that, this event is being streamed live. That's on Biashara TV on YouTube. So probably if you have some colleagues back who would like to stream the event live, we are live on Biashara TV, that's on YouTube. The second thing is geography of this place. If you'd like to visit the gents or the ladies, they are on my left, which is your right. Then you walk this way, and you'll find the washrooms there. So at this juncture, I'd like to invite our second speaker, who's going to give a thought leadership address. It's none other than Mr. David Mukaro, the Chief Executive Officer, Caritas Microfinance Bank. And he's a very good storyteller when it comes to the microfinance sector. So I'm sure you're going to enjoy this presentation. Now, Mr. David Mukaro joined Caritas Microfinance Bank as the CEO in 2021. He holds Masters in Management of Agribusiness, Bachelor's in Business Administration, Diploma in Business Management, and also Advanced Certificate in Business Management. He is dedicated on leveraging digital banking and innovation to foster financial inclusion, and is very passionate about providing women, youth, and the unbanked with the financial tools necessary to drive economic growth and alleviate poverty. So ladies and gentlemen, put your hands together for the Chief Executive Officer, Caritas MFB, Mr. David Mukaro. Karibu sana.
Thank you very much, Mr. MC. Today I'm not giving stories. Today we are discussing very serious matters. That's why we are here. Good morning. I'm delighted to be here with you. Like it has been said, my name is David Mukaro. I was challenged to bring out my thoughts. That's why they're saying thought leadership in terms of what is happening in the market. So I want to put a caveat here that these are not thoughts of Caritas Microfinance Bank, where I work and where I take leadership. I was asked to bring my thoughts and my experience that I've had over the years. So allow me to just be able to talk about what it is that we are discussing. It'll take about 20 minutes to just be able to do that. And I think the topic is very appropriate. We are talking about beyond access. And Dr. thank you very much for talking about digital, because my thought discussion is going to be a lot of what digital revolution has actually been able to do in the economy of this country. And I want to provoke you so that as you get deeper into the digital discussion, as you get deeper into investing into the digital and enabling our people to access financial services, we need to ask ourselves several questions. So when we're talking about beyond access, advancing financial health in a digitally inclusive economy. So my main focus will be on digital health. On digital health. We talk about access, I talk about digital health, and the question now is, It's not moving as fast as I want it because I needed to ask a question. So, I have a question. What does it really mean to be financially included? Because by the end of the day, why we are all here is to include our people as much as possible. So what does it really mean to be financially included? Then, when you look at the country, and Dr. has mentioned a bit of what we are talking about. When you look at Kenya, we are the land of M-Pesa. We are celebrated as that country that has included itself, its people a lot. 84.5% of Kenyans are considered formally included. They have a bank account, they have a SACCO account, they have a microfinance bank account, they have a digital presence. 84.5%. Over 80% of the adults use mobile money. And millions, because of what you are doing, millions of people are getting digital credit, instant, you know. By the time that gentleman, the photographer is walking from that corner to the other, you can have borrowed a facility. By the time that gentleman is walking around, is walking all the way to the gents, you would have borrowed and you would have paid all your services. But there is an uncomfortable truth, and we have seen it. Yeah? There is an uncomfortable truth, and we must face it, particularly practitioners like us. We must keep on asking ourselves, is access to money the same as financial health? Is access to money the same as financial well-being? Is it? What are we seeing in this country? Yeah. When you look at the new financial reality, and Dr. has talked a bit of what we have in the SACCO industry. We have about 38 banks in Kenya with over 1,500 branches. We have 14 microfinance banks with over 108 branches. We have over 300 SACCOs with over 1,500 branches. Over 300,000 agents, bank and SACCO agents across. And the country is working very hard to bring in digital lenders. As of today, we have 227 digital lenders. 600 are awaiting approval at CBK. What is the bottom line? When you look at and when you listen to Dr. what he was saying and what we've been doing across the industry now, that this country now is no longer bank-led. You know, initially you were talking about banks doing this, doing that. That is no longer the story. The story, like we've heard also today in the morning, is that we are digitally led. We are digitally credit-driven. And that is the truth. When all the 600 digital applicants are on board in the next 2 years, we will have more digital lenders in this country than banks, microfinance banks, and SACCOs, deposit-taking and non-deposit-taking SACCOs combined. And that is the truth. And more Kenyans are borrowing on a daily basis. Still on the same digital credit, we have 227 digital credit providers. They say currently, because this is now the current truth, since 2022, when DCP regulation was started, 800 applications have been received, and you can see 227 have been approved. And DCPs have issued quite significant loans. To date, just a few months ago, 7.5 million loans have already been processed through those channels. 7.5 million. Over 133.5 billion worth of loans within that short span. Today, on a daily basis, Kenya is processing over 500 million digital loans. Over 500 million digital loans. So this is a massive expansion of digital lending. It is a good thing. The question is, as I move on to my next discussion, is Kenya overbanked? At least I leave to the policy makers. Is Kenya overbanked? Are we overbanked? Are we do we have more financial institutions than the people? Because the reality is, when you look at East Africa, Kenya has 4.3 banks, and these are banks. If you include SACCOs, then it goes to about 8 for each and every 100,000 customers. That's the truth. When you compare Kenya with a country like Nigeria, Nigeria has 22 banks. Kenya has 38 banks. Nigeria has 220 million people in terms of population. Kenya has about 56 million. So the question is, are we overbanked? Do we have more financial institutions than necessary? Are we overcrowded? Are we moving? Are we changing the discussion? Are we focusing on other things? Was access meant to be an end on itself? And this is where now we are talking about financial inclusion. This is a story that has been told for many years. Financial inclusion. We need to include as many people as possible. We need to ensure that every family, wherever they are backed, either through a SACCO, through a commercial bank, through a financial institution. The truth of the matter is that Kenya is a global leader. We have built one of the most inclusive financial ecosystems in the world. We are actually among the world financial inclusive structures. We are next to South Africa in terms of formal financial inclusion. 84.5% of our people have access to financial services. And this thanks to M-Pesa evolution, digital democratization, fintechs, banks, SACCOs, they've all been able to contribute to what we are talking about. But we must remember that financial inclusion was never the final goal. We kept on talking about financial inclusion. We kept on talking about financial inclusion. But was that the destiny? Was that the journey we were taking? Inclusion, what we are now discovering, very painful, is that inclusion was supposed to lead to financial health. We needed to transform our people. We needed to transform our people. Yet today, if you look at the structure today, statistics can tell you only a very small fraction of Kenyans are what you consider as financially healthy. Financially healthy, not financially included. We now change the story. Financially healthy. 18.3% is 2023 numbers. In the year 2020, that was 39.6%. So we are busy celebrating this country that we are now having more people included in the financial sector. Unfortunately, we are having more people becoming financially unhealthy from 39.6% to 18.3%. The story was financial inclusion, that people will meet their daily needs comfortably. That was the story. People will save consistently. That was the story. People will handle financial shocks. That was the story. Is that the case? As you work very hard, including myself, I'm asking myself also, because me, I'm a thought leader. I am also sitting there with my colleagues from Caritas and asking myself that question. Here, I'm provoking you because it is necessary to provoke ourselves. What went wrong? If financial inclusion is 85% and financial health is coming down from over 40% to 18.3%, what is the problem? And the numbers don't lie. And the people you are working with don't hide. Let's take this market trader called Mary. Mary is an M-Pesa. He uses M-Pesa together with other fintechs. Has taken multiple loans, and that is a reality, and I'm very sure when you're processing your facilities, you are seeing people have multiple loans they are borrowing. And sends money to the family often. Yeah? By all measures, when we are measuring the statistics of included people, Mary is included. We say Mary is included. Yeah? She is financially included. Mary has access to dozens, if not hundreds, of digital lenders on her phone. Nowadays, a phone, you have to go to 3 pages. Yeah, of the screen to be able to, and I can assure you, if I walk around here and I look at your screens, the number of digital providers I will see on your screen are very many. And that is the reality. Yeah, that is the reality. For many, prices of vegetables have doubled over the years. If you look at it based on the inflation, based on what we are going through this country, transport costs have risen, and that is a fact, not just yesterday or even through the Gulf of Hormuz. These are issues that are happening on a daily basis. Customers are buying less. When you look at the statistics, you look at the economic survey, Kenyans are becoming poorer. And you can see, even in terms of financial health, Kenyans are becoming poorer in terms of financial health. And that is a fact. No politics. That's a fact. Those are numbers we are looking at, and that's what we're doing. So when Mary is faced with all these issues, what does she do? Yeah? She borrows more from one digital provider to another. And most of the borrowing is not to grow her business. It's not to invest. She borrows to restock her business. She borrows to eat, because over 40% of Kenyans actually now are borrowing to survive from one day to the other. She borrows to survive to the following day. And every month, one loan pays another. One loan pays another. Kiona imefika tarehe 30 and was supposed to pay for this one, borrows, digs a hole here, and fills the other holes. So it become like moles, digging holes. And every month, one loan is of course paid by the other. Interests are accumulating over the period. Stress is increasing at the same time. Mary is included, but is she financially healthy? Is she? No. Those are the questions we are asking ourselves every day. Yeah, Mary's story is not unique. It's not unique. You see those plans every day. What we are seeing now is a structural shift in financial behavior. Yeah? That people now are borrowing for consumption. Majority of people, particularly those loans people are borrowing in the middle of the night. I don't know where they're going to invest at that particular time, at 3 a.m., because most of the loans, digital loans, are borrowed between 11 and 3 a.m. I don't know what investment decisions are being made at that particular time. Many families now are cutting back on essentials. There is minimal or no savings. And you can see, even when they open accounts, the number of accounts that are going dormant in SACCOs, in microfinance banks, and also in banks out there. That is the story. That is the truth. We are seeing a significant financial health gap. Because that is the reality. We have solved, through what we have done, well done, Kenya. Through what we have done, we have solved for access, but not for outcomes, which is what financial health is talking about. So for each and every loan you are giving, I can assure you, for each and every account you are opening, we need to ask ourselves, is this an access issue? Is this a health issue? Is this an outcome issue? Financial health, when we define it in its purest form, it talks about stability. It talks about the resilience. It talks about the ability to plan of the people. Today, many Kenyans, seated where we are seated, cannot absorb a small shock. They actually say that you included and I included, that we are one salary away from poverty. One salary away from poverty. That if you lose your job today, next month you'll be unable to pay your house rent. Your children will be unable to go to school because you do not have a job. Majority of Kenyans, that's where we are. We are one salary away from poverty. We are not saving consistently. Only 10% of Kenyans are saving based on the GDP information. We cannot plan long term because we are now living from hand to mouth. And that is the reality. It is about financial health. Now, this gap that has been created, what is it all about? Because we have to break the cycle. Yeah? We must break that cycle. The hole that we have dug ourselves in, the challenge that we are facing ourselves, that access is increasing and health is coming down, we must change that scenario. We must ensure that as access is increasing, so is financial health at the same time. Because the two must work together. What we are witnessing today is a system-level cycle that is seeing cost of living increasing. Income are not keeping up. People are borrowing to cope on a day-to-day basis. Debt is accumulating at household level. Savings are declining and vulnerability is increasing. And digital finance is actually sitting in the middle of all that because we are all digital. In Caritas we say 99% of our transactions are digital. And we are very proud, by the way. And we are very happy that 99% of our transactions are digital. Dr. Ali has told us his digital structure has increased over 51% over the last 1 year and is almost going to that 99% in terms of digital provision. So these challenges we are talking about, digital is sitting inside this cycle. Is it breaking that cycle? That I leave you to look at. Is it breaking that cycle? What is happening? We must be able to look beyond access. And that was my story today as I finished. We must be able to go beyond access. We must change the questions that we have. Yeah? Because access and beyond access means shifting the question from how many people are accessing financial services. How many people? We must change that story. To asking ourselves here, as leaders, asking ourselves, Are people better off because of the services I am providing? Because why we are saying what we are saying, and why we are provoking you in the way we are provoking you, access without affordability is weak. People must afford it. We can say it's accessible, but then it's too expensive. It's making our people poorer. But it is, you are accessing it. Access without protection is risky. How are you protecting your people? Ethical banking, ethical financial services. How are you protecting our people? Access without outcome is incomplete. So as we do what we are doing, we must answer those three questions. What are the suggested solutions? Way forward. To move forward in financial health, we must rethink the whole system. It's not just one institution. It's not just CBK. It's not just SASA. It's not just your SACCO. It's not just the microfinance banks. It is not. We must redesign financial solutions. We must move away from the lending focused institutions. You know, we are just talking about lending. Every day you wake up, you're talking about lending. How many loans can I give today? How many? That has to change. That story has to change. We must move it to savings led. How much are our people saving? Goal-based. What is the goal? Even the loan I am giving, what is the purpose? You know where we come from, we say, people will say for development purposes. Development purposes. But have you ever followed up to find out what development that is? Do you follow up from an ethical perspective to ask yourself, what is the development? Yeah? Goal-based, resilience building tools. How are the people utilizing the money they are borrowing? Secondly, we must be able to move to responsible digital credit. We must be responsible. Transparent pricing, better credit assessment, prevent over-indebtedness. This is what is killing our people. In many other countries like India, they've gone through significant challenges with this. And the way we are seeing it from where we are seated, Kenya, people might be moving in this direction if we are not careful. We must strengthen the household resilience. In Caritas, we say kuimarisha jamii. We as a people must be able to build household resilience. What are the emergency saving tools? Can we be able to provide microinsurance? Can we be able to come up with income smoothing solutions for farmers? Can they be able to move beyond what they are doing? We must address the cost of living, all of us, including the government, because no financial system can succeed in any way if basic survival itself is unaffordable. Food, water becomes unaffordable. There is no system in the world that can succeed. There is no financial system in the world that can succeed. It will collapse on its own weight. So as I finish, I want to just mention two statements, and I want to read them for you. That Kenya hasn't just expanded financial access, it has digitized credit at scale significantly. And unfortunately, when access is dominated by credit, financial health becomes fragile. That's my first thought. Financial health becomes fragile. When we keep on talking about loans, giving loans in the morning, in the evening, loans without what I've spoken about, financial health will continue becoming fragile, and we have seen it in Nigeria. It's the same issue in terms of financial health. The future of finance in Kenya is not about access alone. It is about dignity. It is about resilience. It is about real financial well-being. I want to invite you in that thinking. And as you do your work, you focus on that, and we all work towards a certain goal. Asante.
think we can do better than that. Thank you. I'll give a chance for one or two questions. But before that, I would like to recognize one of our key partners who's joined us. That is Mr. Evan Kinywa. Wherever you are, kindly stand up and wave. That is Mr. Evan. Let's clap for him. Is there any question? Yeah, there's one there. One more person. I'm sure when he asks, some of us will open up now.
Thank you. I just want to probably agree more with the speaker, but then what the result that he has given moving forward is whether the industry can be able to rethink about the designs that we are using to serve our people. But then I also want to on the same. When you look at our policy makers, basically, and when you look at the players in the industry, I think we are tending to look more into the players in the industry in isolation, so that again, then when you look at them in isolation, it simply means that the banks will basically be able to look at their policies in regard to the banking industry, and then when you go to the circle, the same. Then you go to the MFIs, you are going to look at them in isolation. And then the question would be, then are we likely to see a possibility in near future whereby the policy makers can be able to look at the global impact that we are causing to the clients that we are serving? Because all of us, we are targeting the same person. Are we likely to see a possibility in the future in this country whereby the policy makers will be able to consolidate their thinking together and then see whether we can have possible solutions and this happen? Yeah, my name is Nicholas. I come from Bimas, Kenya Limited.
All right, thank you so much, Nicholas. Can we get one more question? We have a lady.
Thank you. My name is Paulina Jory. I represent Musoni Systems. A very interesting topic. I have a background in microfinance around 12 years. That was 8 years ago. So I'm able to relate with a bit of what you're sharing. I do see the shift that you shared about the impact on how we now see financial inclusion as opposed to when it was very new. I've seen a shift in where the burden used to sit with the financial institution, where when you're lending, it used to go hand in hand with education. Then we became businesses, now we are just chasing profitability. Then I saw a shift where now the financiers would now push that initiative. When they provide funding, they also provide funding for capacity building, again to educate members towards building and getting them towards being healthy financially. But I also feel, in my opinion, that has shifted. So there's a gap. There's a gap there, and I also see the way forward. But I'm just curious, because you're in the industry, what initiatives are there? Because I feel like the burden has been, now it's at the individual level. When I'm being financed, I'm now responsible, I'm supposed now to be the one to make good financial decisions to be financially healthy. But I still feel there's a big gap. I don't want to say government, like everyone, but I feel like there's room for, if you are building towards shared platforms, if you are building towards interoperability between systems, we also need to think as an industry, coming together to establish forums that are directly targeted to the population itself, not the financiers. I know we have like MFI forums, SACCO forums, educating the staff for the SACCOs and MFIs. Can we have forums specifically for the public where we say, maybe today, for example, Caritas, we have a public participation forum, for example, and we want to teach on entrepreneurship, we want to teach on bookkeeping, not only limited to your employees, but it's like an initiative, a CSR kind of arrangement, where now you have seen a gap in the market, you can partner with Silver Circle, with any other institution, and then you're teaching the public, whenever they go get financing, they are equipped to be able to make responsible financial decisions. It's not a question, it's a comment, it's so many things, but I want to hear your thoughts on that.
All right. If you can tackle those two, Lenny.
Thank you very much. Nicholas from BIMAS has spoken about the relationship between the practitioners or institutions and policy makers. And I want to agree with you. We all need to work together. We all need to work together. We all need to look at the impact that this is causing. And just like doctors, when they are looking at you and they are seeing your health is deteriorating, we must ask ourselves, why is the health of our people? Why is the financial health of our people? We are giving a lot of drugs to our people, a lot of money. We are pumping a lot of money. We are opening a lot of branches. We are opening a lot of agents. We are investing in a lot of digital. We are investing left, right, and center. But this person we are focusing on is becoming more unhealthy. That is a very sobering question. And that's why I was asked to come and ask you that sober question. And for you to start thinking. I might not have the solutions, but we need to, as a country, think very, very soberly. Some countries have actually said the market is very fragmented in their own countries, and they have said we are going to centralize the financial markets, such that the financial market will include everybody. They've included even SACCOs, and they have one regulator. They have one supervisor. So that now, when they are focusing on specific policies, they're able to ask themselves, a policy of a SACCO, if we are to make this policy, how will it affect the SACCO itself, and how will it affect the general industry? Today in Kenya, our regulatory environment is fragmented. Take for instance, and Dr. Ali has mentioned it, and he actually gave a very good example. The common bond SACCOs, NPL is very good. He actually said it's between 1 and 2%. Common bond SACCOs. The PAR, NPL is very good. Open the common bond. The PAR, he says, even in some of the institutions, it's gone to double digits. Can we research and ask ourselves, was that a good thing, or was it a dangerous thing? Was opening up the common bond good for the country, or was it a challenge to the country? I don't know how much research has been done out there, but I'm very sure there's a lot of research that has been done out there. So, and these are so many questions we must be able to bring to the table as policymakers, as lead thinkers in this market. And we must be bold. We must not fear, because by the end of the day, the same customer who is borrowing from Caritas Microfinance Bank is the same one who will go to Stima SACCO, the same one who will go to Mentor SACCO, the same one who will go to. And if they are not financially healthy, you can imagine we are having sick families moving from one institution to another. How will we grow these institutions? How? So we have to ask those sobering questions. So Nicholas, I might not have an answer, but you can see the impact of the decisions, high-level decisions made, open a policy, and the effect is immediate, and we are seeing it. So how do we deal with it? Financial inclusion, in terms of what can the industry be able to do, there is a lot, and the government has done a lot. Yeah, both positive and negative. Positive is where now CBK is saying each and every financial institution that is under CBK must provide financial literacy as a policy. Everybody must be trained in terms of financial literacy, and this is happening. And I'm very sure SASRA and all the other regulators will be able to pick that. And can we be able to have shared platforms? Definitely we should. Definitely we should work together. Definitely we should have these forums together. but we must be able to measure the financial health of our people. That is the common base. If we are giving facilities, if we are giving financial services, and we are not measuring the financial health of our people, so that if we come to you, Caritas, you must tell us, you have given so many loans, very good, but what was the financial health of the people you gave those facilities? Has it increased or has it reduced? That is a common denominator in all the financial institutions, and we must be bold and brave enough to ask ourselves those questions and respond to those questions. Thank you very much.
Right, let's start for him. Let's give him a better I think I love the solution where you say that we have to redefine financial products from lending focused to savings led, goal-based, resilience, guiding tools. And there's something I came across, and somebody was saying, but they were joking that our country nowadays we are in a country whereby you press 0 when you want to make calls because you're being told you don't have enough money to continue with this call. Press 0. Number you have 25 minutes of talk, and then they are saying that for you to make a transaction you have to press 1. So tunatumia 0 na 1 because when you want to fuliza you're told to press 1 to continue with this. But I love the solutions that you're giving. That you just don't give loans without knowing huyu mtu kama ataweza kufanya nini to repay the loan. So thank you so much, Mr. David, for that insight. Right now we want to go to our next speaker very fast. And this is none other than Mr. Ben Mann. Now, Mr. Ben Mann is the Group Product Manager, Microsoft Africa Development Center. That's ADC in Nairobi. And Ben Mann is a man who leads strategy and execution for identity management solutions. He brings over 25 years of experience building software across cybersecurity, mobile payments, Internet of Things systems, integration and cloud services, spanning startups, enterprises, and non-profits. Now, Ben holds a BSc in Computing and Information Systems from the University of Surrey, or is it Surrey? And is the inventor of a patented counter-fraud system. So for those who are looking for solutions in fraud, I think he's going to be bringing a lot of wealth of experience in that. Now his topic is artificial intelligence as the next growth engine for digital finance. So ladies and gentlemen, let's put our hands together for Mr. Ben Mann. Karibu sana.
Very good. Well, good morning, everybody. Hope you're having a good day. I'm very mobile. I'll walk around a little bit as I talk, if that's okay. So you've heard from financial leaders. Now, oh dear, it's the technology guy to talk about technology. So I hope you're ready to talk a little bit about it, but we'll try and keep it at a high level as well to make it interesting as possible. So, as was mentioned, Kenya is my home. So I don't know if I've seen any of you before, but I've been here now 12 years. And Kenya is my favorite place in the world. And it's also the place where the best things in the world come from. Do you agree? You agree? That's good. Yes. I also have this, because my wife is, she was born here. So that's why I said the best things come from Kenya. Yes. So we're going to talk about artificial intelligence or AI. Who has used AI already today? Copilot. Wow, so usage is increasing, huh? These tools are exploding. How can you utilize AI? That's what we want to talk about. And what other challenges are standing in the way of using AI? So, okay, it's one of these, there we go. So if you look back at AI, artificial intelligence is something I was reading about in university, which was a long, long time ago. AI has been around since really the 1960s, since we started to try and build systems that could simulate human intelligence. In fact, one of the first ones that's quite fun, if you haven't looked it up, is called ELIZA. ELIZA is like a psychiatrist. So you can chat with ELIZA. This was built in the 1960s. You can chat with it like ChatGPT, and you can say, I have a problem, and it will say, oh really, what's your problem? Oh, I'm feeling down. And it will say, why are you, and then it will repeat what you said, feeling down. And people found it to be quite therapeutic. All it does is it just echoes back whatever you say in the spirit of a psychiatrist. So those were systems to simulate human intelligence. And then of course we've got game-playing AIs. Deep Blue was one of the first chess AIs to ever beat a grandmaster. And we've had many others that followed in that suit, but they were trying to solve problems. And then we've had the period of time of large language systems that are really just trying to anticipate the next word that it should tell you. So it's looking at all the data in the world, all the internet information. It's turned all those words into numbers, and it's noticed patterns. Yeah, so when somebody says habari, it can try and anticipate, what's the next word to put here so I can respond? And once it picks that word and says, well, maybe from my analysis, yaku, habari yaku. Then it's trying to predict what's the next word it should say. That's how the large language models like ChatGPT actually work. They're anticipating. But in the last few months, a new era of AI has emerged. And it's AI agents that can actually do something on your behalf. How can you think of an agent? It's a bit like if any of you took an Uber or a taxi or Bolt, any ride-hailing service to get here this morning. If you didn't drive your car, what did you do? You got in the car and you said to the person, take me to Movenpick. Yeah? But did you, depending on who you are, did you then tell the driver, oh, turn the steering wheel to the left a little bit more gas, change gear? No, because you just told them the destination and you let them figure it out. It depends on who your passenger is. Sometimes when I'm driving with my wife, she's telling me, hit the brakes. But usually we treat it like an agent system. We give it an outcome and we let it run. And those are the new class of agents that are coming out. You may have heard of OpenClaw. This week, a company I work for announced something called Scout. And it's all about an agent that just runs in the background. Maybe it's scheduling meetings. Maybe it's following up on things. So that's the new era of AI that we've already entered. Systems that can act and act autonomously. Oops, I've gone backwards. Down is up, okay. Down is up. The rest of you who may be speaking. What's happening with AI now is it's changing the game. Whatever game you're in, and of course we are here in financial services, it's changing the game. I remember a few years ago, I was in startups. I created a couple of startups. One was fintech. And the first thing you do when you're a startup is you go out and you look for money and you pitch. And you don't have anything yet, you have an idea. And you go to investors and investors say, okay, you want money to create your idea. Why don't you build it first? Then bring it to me, I'll give you the money. You say, well, if I built it, I wouldn't come for the money. I need the money first so I can hire the team, so I can build the office, create the solution and take it to market. If I could just do that without needing investment, I wouldn't come and ask you to invest in my startup. That was what it was like creating a startup a few years ago. If I was creating a startup today, I wouldn't need to do that, right? Because I don't need so many people. I don't need so many resources. I don't need to build a large organization in order to create something, to build something, to put something in the market and test it. What that means is for all of us, whatever size of organization we are, this is leveling the playing field. It's enabling us to get going. So maybe you're thinking, well, my organization's quite big. True, but what about your department? What about your team? Maybe you're a team of one. Can you execute with AI? Absolutely. So it's changing the rules about how you scale as an individual, as a department, as an organization. You don't need so much infrastructure. You don't need so much skills and resources to execute, to get something done. You can do it with far fewer resources. And everyone in your team, whether they're technical or not, they can take an idea and make it reality. Something that you can test, something that you can try. That's what's really exciting about AI. Of course, if we apply this in the financial services sector, well, what are the main ways or the things that you do? This is kind of cutting it out. The first one is, as the gentlemen have just discussed, expanding access, right? So you can use this technology to make smarter, faster decisions about whether you're going to offer a product to some, essentially, credit decisions. You can experiment cheaper and faster. So when you have an idea, you don't have to be 100% confident that it's going to work and put all your time and resources into it. You can try it out. You can experiment with an idea, see if it works, and if it does, build on it. If it doesn't, adjust it or abandon it. That's exciting. You can also move a lot faster. I was telling somebody this morning a story of where I needed to get information about my business, my customers. And I was talking to a technical guy for a year. Build me a dashboard. I need a dashboard. Yeah? Every 2 weeks I'd have a meeting with him. And he dreaded this meeting because it was just me saying, where's my dashboard? I don't understand my customers. Eventually I just asked an AI, I said to an AI system, the data that I need, is it in there? And it said yes. I said, okay, write some instructions to tell this guy, this engineer, how to get the data out and put it into a system that I can just talk to and ask it questions. You know, I gave him the instructions. In less than 2 hours, he'd given me my data and he'd given a system I can chat with. So if ever I have a question, I just ask and it gives me the answers. That's the power of AI when it comes to speed. And then, of course, managing risks. So being able to look at the patterns in your data and make better, insightful decisions about what you should do. This is the opportunity with AI. So you don't have to go now and get a data science degree and understand statistics and machine learning. You can simply put the data in front of the system and ask it questions. That's the power of AI. And how are financial services organizations all around the world using AI today? Of course, decision making, as we said, but also productivity. So enabling all of your teams, all of your staff to be much more productive, to be able to do work faster. I'll give you an example. This presentation, I mean, it looks okay. It's not a work of art, but it looks fine. I didn't create any of these slides. I didn't type any of these words or put any of these pictures on the screen. Yeah? So maybe you're thinking, yeah, it's not that great a presentation. But I was much more productive, right? Instead of focusing on the colors and the fonts, I can try and focus on, well, what's the story I'm trying to tell? Much more productive. That's what we're moving into. And then, as we said, fraud detection, spotting suspicious patterns in your information, getting insights out of your data, You can spend a lot more time focusing on that because actually extracting the information and analyzing it is faster, easier, and cheaper. And you can do it yourself. You don't have to go and keep asking somebody, can you build me a dashboard? You can do it now, today, yourself. That's what's exciting about AI. Now, of course, any system, any AI in particular, is only as good as the information that you give it. When you have an AI, many people have tried AI and they've said, yeah, it's not very good. It doesn't give me very good answers. It's true. But if you don't give it the context at the beginning, of course it's not going to give you good answers. You can often think of an AI a little bit like a new employee you just hired. It's their very first day. And you start asking them one-line questions. What should our strategy be? Of course it's not going to give you a good answer. It has no clue. So what you need to do is feed it with context. Yeah? So instead of just saying, what should our strategy be? You need to tell the AI, okay, AI, I need you to behave like this. You are a financial strategist. Put yourself in that role. Here's our past financial data. Here's experiments that we've run. Give it all that context, including you as an individual employee. What are you trying to do? What are your goals? What is the way you're thinking? What data do you have? And then you can use the AI to get really good answers. Yeah, it's the same old adage in computer science that we say, junk in, junk out. So you need to put in the right data, the right context to get value from AI. That's where the power comes from. So just as the previous speaker said, one of the first things you need to do when you digitize, you need to get your data sorted out. You need to get it available, accessible, and usable. The great thing about AI is it doesn't have to be so clean. You can throw it in, you can clean it up as you go as well. So what does this mean? For AI to be really powerful in your organization, it needs to be connected to your data. And when it does that, AI is actually really good at finding things. So imagine I had in my server work a spreadsheet of everybody's salary in the company. And I saved it under a file name, I don't know, cookie recipes. Yeah, and there's a list of everybody's net salary. I think it would be pretty hard for somebody to find that. But AI is really good at finding data. So what you have to be careful is when you plug that AI into your organization and give it access to data, it's going to find things. It's going to find information. And it's going to serve it up to users who may not be really looking for it, right? So an employee might say to an AI, oh, I'm feeling a bit stressed and tired in my job. The AI is really helpful. Oh, I just found everyone's salary. Maybe you're not being paid enough. Maybe that's why you're depressed. Right? I'm making it up, but I'm just showing you how AI can inadvertently find data that you didn't want the users to see because it wasn't properly secured. So you've got to be very careful. You need to start thinking very carefully about how you classify and protect the data that you have in your organization. So at that point, now it's important to remember, and this is something that stuck with years and years. One of the very first cybersecurity conferences that I attended, one of the speakers said something that stayed with me. We're all sitting there for a couple of days discussing cybersecurity and how we're going to protect it. And he said, all of the bad guys, those hackers out there that are hacking 8 times an hour, they also have conferences. They share ideas. They collaborate. And that's pretty scary, but that's the truth, and it's been the same for a long time. And so just as much as AI is a powerful tool to scale what we do, it's also a powerful tool to scale what the bad guys do. They're also using AI tools. And so we need to be very full of this. So that leads to a dilemma. I think Yeah. So just on here, but that leads to a dilemma. Any of you in your organizations, do you, because of the risks, block all the AI and say, no, for us, it's too risky? Or do you have the mindset, the YOLO mindset? We all know what that means. YOLO? You only live once. Let's try it. Plug it in, switch it on, let it run. What's the worst that could happen? Well, the worst could be pretty bad. So what's the solution to this problem? Something that Dr. San mentioned in the closing of his presentation, trust. So what you need to do is think very carefully about the trust systems that you have in place in your organization, and particularly for the data that is in your organization. And what's the approach? The best approach when it comes to security? No trust, or what we call zero trust. Don't trust anybody. Design your systems so that any data that you have could be open to attack. That sounds counterintuitive, because what you really want is high trust, right? So why are we saying no trust? Basically what that means is you check every single person, every system, whenever it accesses anything, you check. You check who they are, their identity, and you also check what they're doing. What's the context? So that if, for example, somebody who you trust, the head of your company, is logging in from a device that they've never used before, and they're connecting from a different country at 3 a.m., and they're downloading gigabytes of data, is that what should be happening? That's where you need to have that kind of systems in place. One of the key things I'm very passionate about is passwords are no longer a system that you should be relying on within your organization. Why? Because if I can guess your password, I can pretend to be you. So moving away from user passwords and moving away from the idea of building a digital wall around your data, but acknowledging that somebody could be inside. A hacker, but also an AI. And that's when you need to rethink the approach that you take to your IT and your IT security. This is what we do here. I'm not sure if you've had the chance to visit the Africa Development Center. It's just up on Wacky Way at the Dunhill Towers building. This is a lot of what we hear. We develop software that is used all around the world, and we're very proud of that. We're building solutions, yes, building solutions and research to address challenges that we're facing here, but we're also building world-class solutions. So if any of you are, I don't know, opening up Windows, using Copilot, some of that technology is developed here. We're very proud of the work that we're doing. But a lot of the work we do here is around identity and AI, because the two, as you can see, are very closely linked together. So what are the three things I hope you can take away from this little chat that we've had? The first one is AI changes the game. Don't ever think now about your size relative to the banks. Because AI can now be a leveler. It can level the playing field. It can actually enable you, if you adopt it and use that tool, to move faster, to scale bigger, to experiment, to create those mobile applications quicker, faster, with fewer resources, to be able to experiment. You can use this to outmaneuver banking firms. But you have to remember, for AI to be useful, you need to look at how you can open up the data that you have and make it available to the AIs. And remember, there's not just corporate AI, there's individual AIs that your employees will also be using. So that AI needs to understand their context and only access the data that you want the person to access. So it's really important to think about that. Identity, cybersecurity goes hand in hand with AI. And identity is really important. So you need to start thinking very seriously, how do you identify your employees, your users? Then of course, the AI is the e-organization. And if you can do all of those things, you can leverage the power of AI, make smarter decisions, move faster, and regardless of your size, you can dominate in the financial services industry. So thank you very much for letting me run through my AI-generated presentation. Yeah, if there's one or two questions, love to hear them. I'll be around. Always willing to have a chat. Thank you very much.
All right, let's clap for Benman. I think it's interesting. I've also used AI a couple of times, but I don't trust it 100%. So first you use your head and then you consult AI. I'll take. I know you have so many questions, but I'll take 3. I think you are the first to raise your hand.
Thank you very much. I'm actually happy to be here. I have one major question, and notice you didn't mention it. In the beginning, the early days of the AI, we had a common word or phrase, the mad cow syndrome. I did hear you talk about it. Would you have a comment on it? The mad cow syndrome in AI, where the information is just, people stop using thinking or adding information into the machine, and now the thing is just replaying what it has known from the 60s to date, something like that.
Okay.
Oh, my name is Francis Gucci. I'm from Jethro.
Thank you. Do we take all the questions? I can remember all the questions.
Okay, we'll take one at a time.
Okay, that would be great. So this is a challenge, right? The challenge the gentleman's referring to is also described as hallucinations. When an AI can hallucinate, it can go a little bit crazy, and it can invent answers to questions. For example, in the early days of like the large language models, the GPT models, if you asked it to do maths, what is this number plus this number? It wasn't very good at mathematics, because what it was doing was it's kind of looking at all of the mathematical equations it ever read about, and then trying to find one that looked similar. That's not a very good way of doing mathematics. It's like if someone says to you, oh, what's 6 plus 6? You have to remember back. Oh yeah, 4 years ago, somebody mentioned there was 6 bananas and 6 oranges. Trying to remember the answer rather than actually sitting down and doing the maths. Yeah, so that's one of the challenges with AIs. How can you solve that problem? I mean, one is obviously giving it more context, but the other is giving the AI tools. So this is a technique that was used, that sort of first came in a couple of years ago, and it's a very powerful technique. So what you do is you would so for example, if you asked an AI, what's the credit score I should give this person? Here's all the details. Give me a credit score. Yeah, the AI couldn't do that. But because it wants to help, it might just make up the answer and say, well, you know, the first name is Stephen, and the last Stephen, his credit score was 7, so I'll give him a 7, right? But what you want to do with the AI is, instead you say, no, hang on, AI, whenever you're asked about credit score, use this tool, and the tool might be a calculator, you know, your existing credit scoring algorithm that you've developed. And so the AI knows, oh, hang on a minute, let me not try and guess the answer, I'll make it up. Let me go use the tool, and I'll pass in the information, calculate the result, and return it. As one mechanism to address that issue. But it is a problem with AI tools. They can hallucinate. But again, give it more context, tell it when to use the specific tools, and you can get better answers. Thank you.
Thank you for that presentation. My name is Davis Moriti. I'm head of ICT at Caritas Bank. I'm just thinking, since we are here as SACCOs, MFIs, and you're in that space of innovation, where can we converge? I'm asking this because we have clients, and for this case, I take it to people who are differently able or people with disabilities. and they want to bank. We have these solutions, mobile, but how can they leverage on that? And maybe since you're in that space also, I think one of our presenters, Steve Masako, mentioned that the median age is 31. I'm sure we're looking at the young people, they do not have collateral. So you're in that space where you can quantify innovation. So at which point does a Gen Z use the ideation, innovation, as part of collateral so that when they come into a bank, they can be viewed differently?
Excellent questions. Wow, that's really good. I think the first one there around, how can we provide access to users that have disabilities. Something that I'm very passionate about, and so is the company I work for. What I would say is that here locally, we do have hackathons that we run. We'd love to have some of you come and join. We spend a whole week hacking together, designing solutions. And that would be a great forum for us to experiment and see how we can apply those technologies. Some of the hackathons that we had recently, we had projects very much in this space, looking at how can we work with those that, for example, have like sign language was one of them. So that would be a great opportunity to collaborate and look at solutions that we can develop. And our research team here locally are very excited about those kinds of projects. Just to tell you a personal story, when I was a junior programmer, I worked on a system and I made it fantastic. I changed the interface. It looks so good. I was so proud. I launched this new app being used around the office. And there's one guy called Dave. He wrote me an email. He said, your app is horrible, unusable. I was mad. I'd never met him before, so I went looking in his office. And I can still remember my blood was boiling. How dare he said my app is unusable? So I knocked on his door and he opened. He said, come in. I went in. Dave was bored. And he was using a screen reader. And I was humbled in that moment. Accessibility is so important for those solutions. So it'd be great to collaborate on something in that space. The other question you asked, Davis, is how young innovators use essentially their applications, their innovation as collateral for loans. I'd never ever thought of that until this moment. I think that's a really exciting space to look at. Obviously there are ways to formalize an innovation, things like patents and intellectual property. The barrier, I don't know if any of you have submitted a patent, I'm sure some of you have here. It's an arduous process. It requires a lot of resources and time. How might we quantify the value of an innovation maybe outside of a formal process, like a patent process? I think that's a really exciting problem. I don't know the answer, but it would be great to explore that together. Obviously, I think if young innovators can create applications, which is becoming easier now, maybe we can look at like the following, the user base that's behind it, and figure out a way that could be quantified, put into essentially a scoring system. Because of course, the barrier to building an app has never been lower. Any of us could build an app today. The challenge now is, has it got that user base excited? And I think that's something to explore. Very exciting. Thank you for those questions.
All right. In the interest of time, let's clap for Mr. Ben. Mr. Benman. Thank you so much for that very good presentation. It was very articulate. Asante sana. Now, in the interest of time, we will still be around. So right now, we'll be going for a short tea break. And it's also an opportunity for you to network. I did tell you in the morning that one of our main agendas today is for us to network. So if there's any burning question that you still have for Mr. David Mukaro, he's still around. is still with us, and also for the other speaker, that is Bedman, is still around, so you can ask any burning question, and you can also network. So for now, I'll give you, it's around 26 minutes past 11, so 15 minutes, let's meet at around 1:45, is that right? Yeah, let's meet at 40 minutes, at 11:40, yes. 20 minutes to midday. So tea will be served, it's right there, and you're welcome.
That's the way you use it. You have to have, instead of just going to it good at AI. The AI will teach me. Yes. And it will teach you. And you can say to the AI, test me. Test you. Yes.
Let's wind up kindly so that we continue with our program. 2 minutes to wind up.
Wakilisheni eh?
Ladies and gentlemen, kindly let's get back to our seating arrangement. Let's go back to our tables, kindly. We will have more time to network during lunch hour, and then there's also some time that we've set apart in the afternoon session. So I'm kindly requesting that we may go back to our tables. In time, so that we have enough time for panel discussion, and then we have
I'm the marketing manager.
So thank you so much. Hello? Hello? Hello, are we together? Unanisikia? Hello? I think there is something in your stomach. So right now, when I speak, you should be able to respond. And I think I've met several of you, so I know your names. If I see you speaking, you'll come here and give you the microphone, and then you can assist me. Is that okay? Is that okay? You'll be my assistant MC. So right now, we'd like to go to the, without wasting any more time, we'd like to go to our panel discussion. And you've seen the setup has changed. Now our moderator is going to be Cynthia Achi, who is a media coordinator at Biashara Leo. So Cynthia, welcome. Let's clap for her as she comes to the stage. So karibu sana, and welcome your panel and introduce us to your panel.
Hi, good morning. It's almost afternoon. Good afternoon, everyone, and welcome to StunnerBiz Season 4. We really love to see all of your faces on this season's StunnerBiz. So on today's panel, the theme is Building Resilient Digital Finance Ecosystem. And before I even invite my panel, I'd just like us to unpack this theme kidogo. So when we talk about digital finance, we usually talk about or focus on individual innovations such as digital payments, regulations, digital lending, fintech platforms, and such. But to make an ecosystem, obviously we have to acknowledge that these innovations cannot work in isolation. To build a resilient ecosystem, digital lenders and as all the speakers that have spoken even before me have said, all these innovations cannot work in isolation. We have to come together as different industry in this ecosystem to build a resilient ecosystem. So just to unpack the theme, we have building and then resilience and then a digital finance ecosystem. When we say building, we say, because this is an ecosystem that is currently evolving, even as we talk about AI, as Dave Benman said, as a disruption, it's an evolving ecosystem. And digital finance is now where we bring digital payments, fintech, and regulations in practice. And we have a really able panel. We have 4 panelists. As you can see, the situation has changed on the podium. We have Caroline Gaduru from Kenya. We have Beryl Owino from Kobo Kobo, it's a fintech industry. We had Dr. Patrick Gaduru, but he's been replaced with Nicholas Mokendi. And we also have, that is from Bimas, Kenya. And we also have, Agnes from TAG. So our tech team will give me their profile so that I can read them as they also join us on stage. So firstly, we have Caroline Karanja, the CEO of Amki Kenya. A round of applause, she deserves better. Caroline Karanja is the CEO of the Association of Microfinance Institutions in Kenya, a position she has held since 2016. She's a seasoned financial inclusion leader with over 20 years of experience in microfinance, banking, institutional development, policy, advocacy, and sustainable finance. I'm not going to read all that because of time. Karibu sana Carol. She will be representing the regulation side of this panel. Next, we have Agnes Mudoni from Tala, Kenya. She is the head of growth and strategy. A round of applause for Agnes. She deserves better, guys. Agnes Mudoni is the head of growth strategy at Tala, Kenya, as a leading global fintech company dedicated to building the world's most accessible financial services with over 15 years of deep expertise spanning strategy, strategic partnership, product development, and customer experience. Agnes plays a pivotal role in scaling tech-driven financial inclusion across East Africa. I'm also not going to read her profile, all of her profile, because I will be giving them an opportunity to even introduce themselves in a more expansive way. The next panelist we have is Nicholas Mokendi of Bimas, Kenya. He is the Chief Operations Officer. A round of applause for Nicholas. He champions social economic growth at the community level. Nicholas Mokendi joined Bimas Limited immediately after college as a credit officer, rising through the ranks to a branch manager. Round of applause for that. As a regional manager, operations manager, and currently the chief operations manager. He studied a degree in economics from Moi University. Later, he did an MBA in strategic management from Kenya Methodist University. He will be talking more about, just a moment, scaling financial inclusion, is it? Yeah. Our next panelist, unfortunately, we did not get her bio on time, but I will just go ahead and read it from my phone. We have Beryl Owino from Kobo Kobo. Isha Beryl, she is the product manager for financial services at Kobo Kobo, one of Africa's leading fintech companies, helping Kenyan businesses access credit, digital payments, and other business tools. Continue clapping as she comes. She leads initiatives focused on digital lending and merchant services, helping SMEs access working capital. And through her work with over 40,000 merchants, she has gained first-hand insight into the realities of Africa's transition towards a cashless economy. Clap for my panelists, guys. We have another mic. Oh. I'll give each one of you to maybe introduce yourself briefly, even as we start this panel discussion on building resilient digital financial ecosystem. We'll start with Carol.
Good afternoon. My name is Caroline Karanja, the CEO of the Association of Microfinance Institutions. I'm happy to be here, and I want to say that the association is a member-based organization. I see most of our members here. We currently have over 70 members. Actually now the sector is regulated. So we have the non-deposit credit providers who are regulated under the PCP licensing. And we also have the microfinance banks like Caritas, who are also licensed to mobilize deposits. I think I'll just leave it there. Thank you.
Clap for her.
Hello everyone, my name is Agnes Mulani, Head of Growth and Partnerships at Tala. So Tala started around 12 years ago with this simple focus of solving a problem at the time, which was how can we credit score individuals who did not have formal financial statements. And so our founder and CEO at the time really looked at what other data points could we use to be able to credit score individuals. And so I think we were one of the front runners at the time who started looking at alternative data, which includes phone data and other pieces of data to determine what your credit score is. We were looking at two different key components, your ability to pay and also willingness to pay. Fast forward now, more than 12 years later, we've been able to extend loans worth $8 billion. We've lent over $8 billion in total across Africa, Southeast Asia, and Latin America. We now have more than 14 million customers across our different markets. And we're very keen to see how we can be able to have more collaborative conversations to strengthen financial resilience for both individuals and businesses. Thank you so much.
Thank you. Good afternoon. My name is Nicholas Mugeki. I'm the Chief Operations Officer from BIMAS Kenya Limited. And I'm quite happy to be here to join this team. And I think for us, what we have been emphasizing more is what was being discussed by the first speaker in the morning, the second speaker as well, about it's not all about access, it's about actually financial inclusion, and so we are strong in the traditional microfinance lending, and that is our strength, and that's what we'll be talking about. Thank you.
My name is Berry Lorina. I work for Coco as a product manager, head of financial services. So this includes the credit facilities that we give our clients, and also other solutions like API that they can use to integrate to their businesses. So what Coco does is we provide payment solutions to businesses and also offer them credit in order for them to grow their businesses. So for us, when I heard you're doing a digital finance conversation, I was so excited because we rely purely on digital transactions, because for us, going cashless is one of our goals, but I know we can't achieve that, but that's a discussion we'll have here. But yes, as Coco, we provide solutions for businesses to offer payments through Lipa na M-Pesa. We partnered with Safaricom, and these businesses can also access credit through our platform. These businesses are not interested in credit, we've given them interfaces where they can easily manage their business transactions, track their sales, and also integrate with other payment systems. Yeah.
Thank you so much, and I think we'll start with you, even as we going to start with a broad reflection. Speaking as an industry that has been here for a while, it knows, the way to digital finance and all. What excites you the most when you speak about digital finance in the ecosystem that you are in. What excites you the most when we, let's say we're sitting here in 2030, having the same conversations. What excites you the most about the journey of digital finance in Africa at large?
Okay, so for us, digital financing, let's say, before we got to digital financing, we were mostly relying on mostly banks, only SACCOs. I know we still have them in the industry, but before then we couldn't access even cash, even up to let's say 15 million, just instantly, like just go to your mobile app or to whatever platform you're using to access credit immediately. So for us, for me, the journey where we are coming, where we are digitizing everything, where everything is paperless, that we are making it easier for businesses to not only access credit digitally, but we are giving them platforms where they can manage their businesses securely, and through that they're able to build their credit scores. So I'm looking forward to an economy where people can easily access credit safely, and with financial education at the back end, looking for an opportunity where businesses are able to grow themselves rather than dying because of credit debt.
All right, I think that would be a question for everyone in the panel. What excites you the most and what concerns you in terms of the digital finance landscape in Africa as large and also in Kenya, if we're talking close?
Thank you. As I've just said, I'm coming from the transition of microfinance ecosystem. That basically, what we have done is that for us, we are very strong in terms of touch and tech, whereby we still want to feel that our people as we serve, and basically our business is in the industry proper, group lending model, where we have the Germans from the village and all those other type of things. And so for us, is that we still want our presence to be felt. The mobile platforms for our clients to use for easier access of our services. Our impact as an institution is basically to ensure that again we are still available for them. And our operations is basically that we still have a lot of staff in the field, in the branches, also to be able to go and assess and attend the group meetings. Basically, for us, why we do that is because at the end of the day, we are saying that you don't have basically only to look at give you loans, What we want is that we ensure that we have a person who can be able to stand in there and probably do a little bit of education, have a little bit of working with these people, because for us what we usually do is that we usually operate on a graduated model. And by the way, it's also important to note that when we look at our loan size to the people that we serve is basically 35,000 on average. So you can imagine then if we are talking of targets of doing around 2 billion in a year, it means that every month then they have to probably be able to interact with more than 5,000 clients. But our emphasis is that yes, you can be able to meet that target of 2 billion. But are you also able to attend, these group meetings on weekly basis, basically, or bi-weekly or on monthly? Can you be able also to interact with these people when you are paying for a loan of 100,000, for example? Are you able to work a journey with this person to try and educate this person? How do you spend this money and ensure that you don't match the money that you have been given? And I think for us that is what is very exciting. It's a very good way of doing business in the era of technology. But for us, I think we are strong in the issue of touch aspect, that we have to be there. We have to talk with our clients. We have to see this client is able to borrow a loan of 20,000. In 10 years' time, he can be able to borrow a loan of 500,000. In 20 years' time, you can be able to borrow a loan of 2 million. And that has been our joy in this industry. And that's what we are able to get excited as we continue working in this traditional lending of microfinance. Thank you.
Really good insights. Agnes?
Thank you. So I think for Tala, we started out as a digital-first company. So digital finance is really how we operate. I'll tell you what I'm most excited about. I don't know how many of you were around when we used to have traveler's checks. Do you remember those? And I remember when I was going to university, my parents gave me a traveler's check. And that thing I remember I was told, keep it safely because if you lost it, that's it. It was going to be very hard to trace your money. That was like losing cash, right? Fast forward today, you know, you can have your money stored in different formats, right? In a digital wallet, you can have your money in the bank and then, you know, request for it using, you know, different ways, RTGS, PesaLink. So I think those are the benefits of digital finance. That's one of the benefits. The second benefit is going to the bank was an entire day's process in most cases. You had to wake up early, dress up, look formal, presentable, and then you had to line up for hours and hours on end. And now, just with a touch of a button, you can easily move your money from your bank account to your wallet, send it, make payments, and this is just the beginning. I think there's a lot more that we can see and we can get excited about in terms of the future of digital finance. Let me talk about what I'm most excited about right now, and particularly with this conversation that we're having. For a long time as financial institutions, we were measuring access. We were really monitoring and tracking the percentage of people who could access digital loans, credit, bank accounts, credit cards, and so forth. But I think the assumption that we had was when we were measuring access is that access would translate to financial health, which it hasn't, right? And let's define what is financial health, you know? Financial health is, number one, are you able to pay your day-to-day expenses? Are you able to pay school fees? Are you able to pay rent? Are you able to pay for food? It's also, are you able to absorb any emergency shocks that may come up, whether it's for yourself or for your family? So for example, medical bills, is that something that you're able to absorb? Thirdly is, do you have the knowledge and the understanding of what it takes to be able to achieve your financial goals? And then lastly, do you have access to those financial products that will help you achieve your financial goals? Together with, do you have the confidence? And when we look at where we are today in terms of financial health in this country, only 16% of this population, these are statistics that were run, I believe, last year, are considered to be financially healthy. Another number that I remember reading was 30% of individuals who've turned 60 years old in this country today are able to pay their bills on a month-on-month basis, meaning that the remaining 70% who've attained or achieved that age of retirement cannot afford to retire. So even as we're thinking about digital finance and how can we use it to further drive financial health, I think there are many opportunities. One of them is financial education, which has been talked about at length with the previous speakers. I think that's a really key component, but also financial products. How we can make it more readily available for everyone so that they can be able to achieve their financial goals and make their money work for them. Thank you.
Thank you so much, Agnes. And I think we're one of the most luckiest generation because I can't imagine waking up at 9 a.m. to go to the bank to withdraw money. Carol?
Oh, thank you. Well, the panelists have said it all. And it's also good to, of course, have practitioners who are seated here with us. At the association level, of course, we are happy when we see, and what excites us most is, of course, seeing our institutions transforming to the digital, into the digital space. And at the policy level, I must say that we have to know that we should not regulate technology actually. We regulate the outcomes. Because what happened when, I think you remember when the emergence of these digital lenders, Tala was there for long. Tala has been stable. Tala is, it is known. But then there were so many that came up. I think today from our previous speaker, we were told there are about 600 applications there. So, and I know at least one of you has received messages or, those predatory lending methods that were there, collection methods that were there. So what I say is that we are happy when the central bank came up with that regulation for that. And that was exciting for us, even at a policy level, because it was coming to distort the market. So the excitement for me is having a proper policy that is there, that is, managing this and bringing the market integrity, as well as seeing our institutions evolving and now becoming digitalized. I think my colleague here has spoken very well, because even for me, I can't remember the last time I went to a bank to sit there to wait and withdraw money. Now at the touch of the button, you're able to transact. But there is one thing that a former speaker, I think the CEO of Caritas spoke and said, and this comes again in terms of financial health, where you see there are applications that come, the digital applications that come very weird times in the night. Is this really financial health? You're borrowing to do what with that money at that time? Are you really investing, or So there's various questions to ask about this digital space that we are in. Thank you.
Thank you so much, Carol. And I'm really glad you talked about, not regulating digital or technology and regulating the outcomes. Now, my question goes to you. It goes, innovation. Could you say that innovation is probably moving faster than regulation? And how do we ensure that policy both enables innovation and also protects consumers at the same time?
So, as I've said, innovation and regulation should not oppose each other. So what regulation would be doing is at least bringing sanity into the market. So the focus should actually be more on transparency, data privacy, and I think earlier on there was also a speaker who spoke about the data privacy. There should be responsible lending so that we promote the financial health. There should be the market integrity. And with this, if regulation can stick to that, focus on that, then the innovators would also now have a room to be able to develop new solutions that would come into the market. So I believe they can work, they should not oppose each other, but complement each other. And remember what I've said, you don't regulate technology, you regulate the outcomes.
Thank you so much, Carol. And I think we'll move back to Agnes, and I'm glad Carol has maybe touched on transparency, data privacy, and trust, because Agnes was supposed to talk about, data-driven lending. And let's talk about the data. We're shifting from collateral-based lending, and I think from what you said, Tala was here from Kitambo. So we're shifting from collateral-based lending to data-driven lending. What data is most valuable today, and where should we draw the line on privacy?
Mic check? Okay, yeah. So what data do we use when we're credit scoring individuals, and then where should we draw the line when it comes to data privacy? So let me talk about what are some of the, what is the output that we want to get at the end of the day when we're assessing someone's data. So the first output we want to get is we want to first better understand the individual's ability to pay back that loan. So if I'm giving you 5,000, I want to be able to understand, can Cynthia be able to pay back? Does she have enough money? You know, when you deduct your expenses, your monthly expenses and everything, do you have enough money left to be able to pay back that loan? And then the second thing we also look at is willingness to pay. When we look at also collateralized loans, part of the reason why we decided that we did not want to use collateral is how many of us had a physical asset when we were starting our businesses or when we were at the point where we needed a loan. Very few people had that, right? And also, when we look at also from a gender perspective, you know, there's a large majority of women traditionally who are disenfranchised from that perspective. And so we wanted to make access more open so that we could ensure that more people, regardless of your background, could be able to access loans. So that was part of the reason why we made the decision not to collateralize our loans. Now let's look at the data that we typically use. And that is typically used today, right? So today, typically, whether you're getting a loan from Tala or whether you're getting a loan from other maybe digital lenders or maybe even other telcos, typically they'll look at transactional behavior or transactional, your historical transactions. So whether it's through M-Pesa, they're looking at your so and that's why what you'll find is a lot of fintech institutions will ask you for your M-Pesa statements, right? The other thing that we look at is we also look at behavioral data. Behavioral data is also really powerful because it gives us strong signals in terms of whether this person can take this amount of loan and pay it back on time. When I talk about behavioral data, what I'm talking about specifically is, I'm talking about even how someone interacts with the product, right? With the app, you know, they're just some basic, you know, principles or things from a product design perspective, and Beryl can share more, that the product development team will put in place to help us pull some information. Beyond that is also how you're, you know, getting that loan, the loan size you're taking, when you pay it back, together with the frequency. So those are the different types of data points we look at. From a credit scoring perspective, one of the things we encourage is that I think it's important get back that loan. On our side, what we do is, if a customer does not pay back in time for a certain duration, then we will proceed to list that person using the Credit Reference Bureau. So it's things like that that we've put in place to ensure that, one, from a data privacy perspective, your data will not be shared. We actually That's one of the first things to look at. Are they regulated? What body of organization is regulating them before you proceed to get a loan from them?
Thank you so much, Agnes. And even as we talk about data privacy, I have had a lot of speakers talking about, you know, the CEO of Caritas Microfinance Bank had talked about financial health. And Agnes just stated that only 16% of the population in Kenya are financially healthy. So going back to Nicholas, technology has definitely increased access to credit. How do we ensure that this access translates into, you know, real economic empowerment in terms of, you know, digital transformation? I think Berian can also touch on that. How do we ensure that it translates into real empowerment economically?
Thank you. So what we have been able to do probably is also to you know, come up with more platforms that can be able to help our clients for them to be able to access financial services faster. Well, we have been able to be very innovative in that area. We still have a lot of work that we have to do in terms of when our clients are assessing our loans and other financial services. Whether at any particular time we should be able to look at the cash flow of our clients and look at their businesses and you know, bring the cash flow analysis for them, so that is able to help us determine whether this person probably has an ability to, you know, borrow a specific amount of money and be able to pay, you know, through the business and not any other sources, physical through their business. And that can only be determined by a serious appraisal of the cash flow analysis of the business. When we are able to achieve that, then the next thing that we should be able to ask ourselves is when we look at the pricing models that we are using, are we able to ensure that our clients are able to understand that basically our products are priced at this particular? Are we able to get to a point where we are able to disclose every cost for that particular loan, so that again there is nothing that is hidden. There is nothing that is hidden. So when I'm applying for a loan of a specific amount, then I'm able to know and plan that I can be able to probably within a 1 year period, This is the much I should be able to draw from my business and be able to do. So what we have been able to do is that we ensure that at the end of the day, our customers are given all the information that they require for them to make decisions. Then when we look at microfinance, the traditional one, of course, basically our business model through the group lending. And so what we ask ourselves when we go out there is, can we be able to allow people from the same location come together and use the social capital within that village so that they're able to do a common project for themselves? You see, when we get into a group of, for example, 20 people, and then I take a loan and that person take a loan, there is what we call group cooperative system. So that, because again, these people don't have securities as you're saying. The only thing that we can be able to do is that in that particular village, then I'm able to say that I know Nicholas, another person says that I know Nicholas, and then I'm able to, you know, sign for Nicholas to be able to take a loan of 100,000, basically using my name, not any collateral that I have. But I'm only saying that we come from the same village, and so if he takes a loan of 100,000, he should be able to pay, and I can stand in for him. That is what we usually call the cooperative system. And so once we are able to take loans individually, then the next question that we are doing, we are asking ourselves, can we be able to allow these people to take a project loan that, yes, I'm having my personal business, but can we be able to take a loan that we can be able to do something that is in common as a group? And that's why we have seen people basically taking loans and buying tanks. You know, we take a loan as a group of 200,000 and we say we are going to buy tanks for 10 people. So you know that brings a lot of cohesiveness within the group, and now that can give them a lot of you know, encouragement that yes, I can borrow as an individual, but at the same time we can be able to do a group project that can be able to propel us and continue being able to be cohesive and continue looking ahead in terms of as a group. I want to give an example of one of the groups that is in a place called Kitengela. And that group was formed way in the year 2012 thereabout. And of course it has around 30 people. We are talking today and they have been able to buy land worth 12 acres as a group. They are doing their personal businesses, but we were able to help them borrow loans as a group. They started with 500,000, they borrowed 800,000, they borrowed 2 million, and now they have been able to buy for those many years, a bunch of land that is close to 20 acres thereabout. And so then we are able to define to ourselves and start developing. And I think that the story that has been duplicated to other areas. Then, of course, again, we are also looking at, when we are looking at people applying for loans, are we able to analyze, of course, through the credit scoring system, as he has also indicated, savings patterns for these people, so that also that helps us to make a decision. Are we able to look at the mobile, transactions within their phones, and that can help people to tell us, this is the much that I'm spending on probably fuel, this is the much I'm spending on fees, this one, that also helps us to make a decision in terms of lending capacity. And I think finally, and this is good for us as an institution, is an aspect of training. Our staff and our credit officers on the cloud, they have to be taken through a process every time we are onboarding. How do you, apart from lending, how can you be able to spend at least 50% of your time when you are attending to our groups on trainings? And what are we training on? We are training about group records. We are training about business skills. We are training about market linkages. We are training about value chain development. And I think for that, those are some of the things that at the end of the day, then we are able to ensure that our clients also they feel the impact of our our products on the cloud, and our people are also able to get to a level where they are trained so that they can be able to impact the people that we are serving. And that is what has kept us actually. Remember, as I conclude, that when we came in this industry many years ago, we could form groups of women of 50. And along the way, the feeling was that people don't necessarily want to get into groups again. But I want to surprise you today, we also forming groups of more than 30 people. And it cannot depend on basically what is it that you have for them. It's not only the loans, can you be able to also sell other benefits of that kind of group cohesiveness, and also what kind of product can we be able to borrow as a group, and what can make us also be able to stick together even for the benefit of each other. I think that's very key for us.
That's a very powerful model, the group learning model, and as when you talk about access translating into real empowerment in terms of economy, we've seen massive growth in digital payments, and Kopokopo is at the core of it. But still, cash still dominates the SME sector. What do you see as the biggest barrier to a truly cash-light economy? As you had said, you are excited to see a cashless economy.
Yeah, thank you. So as much as I'm excited, or anywhere I go, I see when I walk to any business and I see they don't accept cash, to me gets me excited, because I look at this, if they're not our client, this is a potential client. But we must admit, in Africa currently, technology isn't the challenge when it comes to digitizing payments. So when it comes to digitizing payments, most businesses have different needs. So, for example, I'll use, when you go to, I don't know, if you visited Gikomba, most businesses don't accept digital payments. Most of them will tell you, go and pay for cash, mainly because of trust issues. Most of them will tell you, if you send me money, you're going to reverse it immediately after that. So as a business owner, if you're trying to convince me to switch to digital payment, you need to also give me that encouragement, or make me trust you that this payment that I'm receiving is secure, and at the end of the day I'll receive it. Other businesses that are small margin profits fear digital payments because of the transaction cost. So if you go to such businesses and you only sell to them that accept payments digitally, to them, if that is not an advantage to them for the business. So a business would maybe accept the payment if my business, I'm looking forward to being able to do, let's say, proper reconciliations at the end of the day without the hassle of counting money, then digital payments works for me. And at that point, I will not consider cost. And if I know if this money that I receive it, I will be able to access it fully and any time I want it. To me as a business owner, that is safe and secure for me, and I'll transition to digital payment. But as long as we still have the trust issues, and as fintechs still going out there promoting accept digital payments without any additional values, then I think we'll still have this cash transactions still going on, because cash to some businesses feel like it's so real. I have my money, I've seen it, and I can easily use it anytime I want. Unlike digital, where there might be an issue, the customer has transacted, there's a delay in the notification payment. I think most of us have seen this in supermarkets. When people are paying, sometimes you even get frustrated, you wish you could pay cash so that it could move faster, because sometimes digital internet has made it to ambusha, but I'm glad that the way we are moving forward currently in Kenya, it's most businesses are now adapting to cashless payments simply because they can easily trust, they can easily trace their money where it is, and at the end of the day, I don't have to lock my salespeople somewhere in the corner, each of them counting for me how much they receive, as we look at a counter book maybe where they were writing sales down. So at least it's still a work in progress. We can't get there yet 100% because we say technology has been built by human and it can fail any day, any time. So there's still that gap that needs to be bridged.
Thank you so much, Beryl, and I'm glad you've talked about trust. And as we go, because I know this conversation is going to, it's not going to end right here because we still have some networking sessions. As you give your closing remarks, can you talk about maybe the trust that you're talking about in terms of consumerism? And all of you, could you also talk about, when we sit here in 2030, let's give it 4 years, what are your concerns in terms of digital finance as you give your closing remarks?
So currently, my concern would have been with digital finance. I know there's a time when we had a lot of digital lenders coming in and out from anywhere, and some places you could go and maybe send your application, you ask for a M-Pesa statement, and sometimes someone will receive Chama money, so it doesn't mean that that's my ability to pay. So we end up giving people credit that they're not able to pay, and then harassing them in terms of repayment. So what for us, Kopo we've done, for us when it comes to lending, we look not only about your willingness to pay, but also your ability to pay. So that means when you come to our platform, you need to transact with us for a period of time. We use that data to score you. And when we score you, we look at this business. These are the transactions you received this month. If we deduct you 20% of this, is this business still going to survive? So those are the things we do for our businesses. And thanks to that, our loss rate currently is around 4.5%, which is way below the industry loss rate. It's not like we're not taking enough risk, but we've been trying to increase our risk appetite because we are even giving some merchants about 30 million in less than 30 minutes, which they can easily access to grow their business. But the journey we walk with our clients really matters to us. So I'm looking forward to a future where when we are advertising our digital loans, we are not just sending a pretty lady there who looks good to advertise it to, and then when it comes to collections, then it's bulldozers in your business, we are harassing your contacts. It's a mess, and it's making other people scared of financing. Like some people have the capability of paying, but if they imagine what if this happens and I'm not able to pay, what will you guys do to me? So for us, it's a journey with us, with the customer, even as the business, because we know some business are seasonal. For instance, use like, let's say, textbook shops. When schools are opening, especially in January, they are selling more books as compared to when like schools are already in session. So you know such a person, there's a time the transactions will go up, there's some go down. So when you work with this client, with them, you're not shutting down their business, you're not harassing them, you're like, I know your business is done, but just
give me my money. It's not about that. So because as your business grows, it means in future you might even come for bigger limits from us. So if we could embrace working with our clients, treating clients as humans. I know we have a few fraudsters who might come and try to take advantage of how your processes are, but that's where our product comes in, where we build technology that is able to help us cap and reduce our loss rate when it comes to that. Yeah.
Thank you so much, Daryl. Nicholas?
Thank you. I think for me, the major concern when we talk about digital rooms is basically, previously in this industry, it would have been very difficult for any person to get a loan if you are listed negative with CRB. That was very, very difficult. But see now with many players coming in and many of them not reporting in a central place, it simply means that majority of people can be able to still borrow, not pay and go and borrow in another place. And I think that's a tendency that already we have seen with quite a number of areas that we're operating in, where people just borrow because that money is available through the phone. But then, even if I don't pay, the loan that I took yesterday, I still can be able to download another app on my phone and still borrow to another place. And I think it's becoming a major concern because at the end of the day, if then I lose my money as an institution because I gave money through the mobile lending, and then tomorrow another player also loses money, it simply means that then what we are talking about in the morning, the NPL, is basically going to be unbearable for all of us. And so I think at the end of the day, what we should be looking at is, as many come and we are being regulated and being given licenses, do we have a platform whereby we can actually be able to be regulated in a way that we don't allow people to borrow money that they cannot be able to pay? And I think that the biggest concern that we have in the industry, and maybe in terms of the policy level, we have an opportunity in this country whereby we can be able to ensure that then, as much as I'm getting trainings and I'm able to borrow, then I'm also not allowed to borrow money that I cannot pay, and then I go to another person to borrow, and not pay, and at the end of the day, then all of us, this is a very big concern that we have in the industry. Thank you.
Thank you so much, Nicholas. And I think maybe we'll have some answers with the following addresses that will be coming up. And also for the tech guys that are in the room, I'm sure you have some questions on that as well as maybe solutions to that. Agnes?
Yeah, so I'll touch on what Nicholas has talked about. So for me, it's not necessarily concerns, but it's more around what enablers do we need to put in place to further unlock the possibilities of digital finance. If you look at some of these more stable, progressive markets, economies in other places, what you'll find is that they have a very strong credit rating, credit scoring system, which then enables their citizens to be able to access credit, or mortgages, without necessarily even having that money with them at affordable rates. And I believe that's something that's possible. One of the enablers or one of the factors that could make that a possibility for us is what Nicholas talked about, which is really part of creating a more unified, universal credit scoring system, where there's more open data that is shared, and where even our credit reference bureaus are unified. Whatever data they have, whether it's also the banks, microfinance institutions, that information is being stored in a more unified way. I think that's one of the things that would really be exciting to see. I know with open banking, that's already something that's currently work in progress, and hopefully we can be able to see that come to fruition soon. I think what would get us there sooner is ensuring that all of us who are in this space, whether you're in the microfinance space, whether you're working in a bank institution or fintech institution, that we all are working towards a common goal, and we're all incentivized towards really enabling that customer, and empowering them and supporting them to achieve their financial goals.
Really powerful. I think, yeah, Caroline?
Okay, I think being the last listening to the practitioners here, Anyway, so in closing, what I would say is that we have different players in the market in this digital lending space, and what I feel that we should all collaborate. I think you've talked about. I think my colleague here has talked about working together, with the different partners. So what I feel is that there should be a collaboration between the fintechs. Fintechs provide the platform where they bring technology, they bring the speed, so they create that particular platform. And then there's, for me, I'll talk about microfinance institutions. You had what my colleague Nicholas from BIMAS has talked about. Microfinance will also bring the financial expertise. They will also bring the customer that we are serving, the persona or the person we are serving, especially the underserved communities. And then we have the regulator or the policy maker who also come now with the oversight and also just that market integrity. And I think that is what also brings the trust that we are talking about. When a customer is also feeling there's some oversight or some regulatory framework somewhere, I think there's that trust, especially when it comes to also, data and all that. And then lastly, our developmental partners. So when they come in, and I remember earlier on there was a question from somebody from Boston who was asking when she knew of the developmental partners before, they would come with particular aspects. Till today, they still do that. So as much as they'll come with the catalytic funding, because one of the things that we suffer from is access to affordable and sustainable funding. When they come in with that funding, it also comes with an aspect of TA and capacity building. So, but I also heard what you were saying in regards to even having it publicized, like having forums which are public for financial literacy and so on. So for me, in closing, I would feel if all those four players do not work in silos and they collaborate, we would have a stronger digital lending space. Thank you.
Thank you so much, Carol. And it brings to the attention what I had said earlier about all of you guys not working in isolation and actually working together to build a resilient digital financial ecosystem. Unfortunately, we will not be having a Q&A session because of time, but I'm pretty sure this conversation will continue happening since we have a different forum after this. Thank you so much to our panelists. Do we have a photo session, Felix? Do you have a photo session with the panelists? And then, okay, cool. Thank you so much to our panelists, guys. A round of applause for my panelists. If you have any questions regarding building a resilient digital finance ecosystem, you will get a chance to network with them and ask questions about the topic as well. PK? PK is short for Paul Kamau. I call him that, sorry. Oh, a round of applause for me, guys.
Thank you so much. Let's escort them with another. Oh, are you okay? Najua nimeanza kuangalia time. Yeah, but we started a little bit late, so there are some speakers that I might be forced to push them in the afternoon. But just before that, we are going to extend at least for the next 30 minutes or so, because our speaker right now should not be available in the afternoon. So we have to release her, and it's important for us to listen to her before she leaves. Fair enough? So her name is Caroline Gathuru. She's a communications, leadership, and customer experience strategy. Her topic is financial services, customer convenience, the digital wallet war to win customers for life. It's an industry perspective address. So let's clap for her as she comes to the stage. And I can assure you, you're going to love this. Sawa sawa. So let's hold our stomachs kidogo, at least we've deposited something, and then we'll be able to go for lunch, to break for lunch. So karibu sana Caroline.
I am standing here. Is this the middle of this stage? Is this the middle? Yeah. Or should I go a little bit that way or that way to be in the middle? Is this the middle? Yes? Yes. You don't sound convinced. This is the middle. All right. I am standing in the middle, in between, right in the middle of you and lunch. What a place to stand. And so we are having a discussion just before lunch about the customer. We have talked a lot about digital, we have talked a lot about what we need to do to transform. But now we want to talk about the customer. And as always, we always say, start with why. Start with why. Why must we talk about the customer? Why must we talk about this digital war for the customer's wallet? Everyone is digitalizing. Everyone. Why? Why should we talk about the customer? We are talking about the customer because for whom? For whom are we running around like this? For whom are we investing? For whom are we making a change? For whom is transformation being planned, implemented, invested in? For whom? And that's why. Because if we don't start with why, and if we don't understand why, then everything else that follows is not going to work. So that's our why, and this is what we want to talk about between now and lunchtime. We promise, I promise to keep it short and sweet. Okay, so, what's up? What's up? What's up? What's up exactly? What's up? What is up is financial services industry is fighting a digital wallet war. We want digital wallets. We want everyone to be on their phone, accessing our services, accessing our products, accessing our brands. It's a war, it's warfare. That's what's up. So the financial services sector, the financial services industry is fighting a digital wallet war. And the customer is simply trying to live their lives. Two different things, like a dichotomy. Financial services is innovating, inventing. You had here from morning doing 1, 2, 3, 100 things, lots of statistics. That's what's going on with the industry. But what's happening with the customer? The customer just wants to live their life. That's all. That's what's up. If we're going to speak in that language. That's exactly what's up. And what does this look like? The drive is to acquire space on every single phone. In fact, if you had market share on every single phone, you would be very happy. You'd be meeting your targets, you'd be running happily into the sunset. That's the drive. Now, what's the need? The need is actually to acquire space, not in wallets, but to acquire space in customer trust. This trust word has been said so much this morning. To acquire space, we are looking for space in customers' phones, and we need to be looking for space in customer trust, customer confidence, and customer loyalty. This is what we need to be looking for. Financial services here is everyone, every one of us. Those in microfinance, those in banking, those in insurance, those in digital and mobile finance, those in telcos who have now switched into being financial services provider, anybody and everybody in this space, circles, all of us, financial services industry. we are running after space in digital wallets. And we need to be running after space in customers' hearts. Because for sure, qua ground, things are different. Very, very different. And at this point, I will ask you all, please stand up. Stand up. Please walk 5 steps in any direction and stop there. Starting now. 5 steps in any direction and then stop there. Have you done your 5 steps? Yes. Okay. Some people are looking that way, others are looking that way, others are facing that way, others are facing this way. At this point in time, I want you, each and every one of you, to look at yourself very, very, very sorrowfully. Very sorrowfully. Because you have really just absolutely done the wrong thing. How is it that you're told, get up and walk 5 steps, and then you just get up and you walk 5 steps? Why? Why? Why have you walked 5 steps? No one has stopped to ask which direction is this 5 steps? What's the pace of these 5 steps? Why are we walking 5 steps? Are we going fast? Are we going slow? Should I move to another? You have just gotten up and walked 5 steps. Just blind obedience. Blind obedience. Now for me to release you to go back to your table, please just pat your heart and say, nimekosa sana. Nimekosa sana. Forgive yourself. You can go back to your seat. Go back to your seat. Go back to your seat. Where are we going with this? Where are we going with this? You know, the man with the mic is the king. The person who stands here and holds the mic holds the utmost authority. Authority is not by title, authority is by whoever is holding the mic. Because for sure you can be in a function with the king of which country? Let's say the king of England, that's the king that comes to mind. Or say the president of this country, and you hold the mic and you say, please turn to your neighbor and tell your neighbor good morning. And everyone will be obedient to exactly what it is you have said. So what are we saying? Who has the mic? Who has the mic in financial services sector? Who has the mic? Who are people being obedient to? Who are we obeying without question? Is this illusion? Is the illusion that customer convenience via digitalization is working for the customer? That is it. That's the person with the mic. Whose convenience are we talking about? Are we talking about our own convenience, or are we talking about the convenience of the customer? Question. Whose convenience? And as with every illusion, it hurts the eye. It hurts the eye. If you look at this for too long, it hurts your eye. The illusion that we are digitalizing, the illusion that we are automating, the illusion that we are bringing solutions to customers' wallets is with us. Because whose convenience are we talking about? Are we talking about the customer's convenience, or are we talking about our own convenience? Point for reflection. This is what we gain, we in financial services sector. And when I say we here, I am speaking from a space where I have been there, done that. We're talking with my namesake Carol from Amphi. And I did a 4-year stint as a chief executive officer at a microfinance institution. And you know, when you're in microfinance, you're everything. You are the banker, you are the bank. You are the lender, you are lending. You are the digital solution provider for mobile financing, you are that. In fact, that is where the rubber meets the road. We even had an insurance agency, so you're even in insurance. We were running an enterprise that was financial services from the deep down to the higher. And so we are talking with Carol, and we're asking ourselves at the back, because we're on the same team. So this is what happens when you automate, when you digitalize. You reduce operational costs for sure, they go down. You reduce foot traffic. As previous speakers have spoken about how foot traffic to the branches has reduced dramatically. You reduce that. You reduce call volumes. People are not calling you. They are on their phones, transacting. They don't call you. In 2 minutes or less, they have done what they need to do. More manual processes have gone down. Wage bill has also gone down because the number of people it took to do manual things has significantly reduced. And the customer journey goes down. However, what is it that increases on the customer's side? What happens? Because as we gain those gains, what happens to the customer? The actual customer, what happens? Multiple apps many times, multiple interfaces, passwords, endless passwords. I don't think our brains were created for passwords in this way. And then when you try to input your password, what does the portal tell you? Let's say I decide my brain cannot. It cannot hack. I have brain fog. I am in my 50s. Menopause is killing me. I cannot absolutely remember these passwords. Then it wants a character. What else does it want? A number. What else does it want? You cannot use that space. It cannot be your name. The strength is crazy. So this is what we are doing from the customer's perspective. From the customer's perspective, right? Authentication layer after authentication layer. Many updates, tech updates, some of which we do not opt in. I know as you sit here, you are feeling the pain of an update that you did not opt into and is currently running and ruining your life. Look at your neighbor, you know which update that is, right? That is the customer's experience. As we digitalize, as we wage war for their wallets, their digital wallets. What else is going on with the customer? A very complex onboarding. This complex onboarding asks you for questions, security questions. What was the name of your first pet? You know that one? What is that? Can they not ask me about African foods? Can they not ask me about the name of my teacher in primary school? Things that I would remember. Some of this onboarding is very, very painful for the customer. This is the cost to the customer as we run after their digital wallets. Just complex digital journeys. Go here, go there, go. So as we look at this, as we look at fighting for the customer's wallet, digital wallet, and putting ourselves in their phones, because it is said that when we wake up first thing, we look at our phone. When we go to bed last thing, we look at our phone. And so the more market share, the more space, the more digital space we get in the customer's phone, the more we have won. So what do customers really want? What do customers actually want? What do they want? They don't want the things we are offering. Because these are the things we are offering. We are offering apps, banking apps, we are offering insurance portals, we are offering mobile wallets, we are offering digital lending, we have had these loan platforms, we are offering tools, funky tools from our circles keep on sending us, spaces and places to go into, to make our lives easier, we don't have to come in. We are offering payment interfaces, savings, dashboards, on and on and on and on. This is our offering. And many times when we stand there, when we talk to customers, these are the things we say. We will offer you this. We'll offer you ease. We'll offer you convenience. We'll offer you one touch. We'll offer you time savings. This is what we will offer you. And this is what is on the menu. But what do customers actually want? What do we want? We are the customers. What do we want? We want to pay school fees. That's it. School fees is killing us. Killing us. We want to pay rent. We want to pay rent. We want to pay for services. We want to send money. We want to receive money. You know that notification for receiving money? That's the one. We really want that one. To receive money. We want to pay our staff, we want to pay salaries, we want to pay the people who work for us, we want to pay salaries. We want to grow our savings. We want to protect our families so that their future is secure. We want to buy a home, we want to solve problems, and on and on and on and on and on. This is what customers actually want. And so the question we are asking ourselves today, if this is what customers want, what language do we need to speak to them in so that we are delivering what the customer actually wants? The earlier speaker spoke about how people take digital loans at 3 a.m. in the morning. Why are you not asleep at 3 a.m. in the morning? Why? The table there is saying stress. And then, why are you not sleeping at 3 a.m. in the morning? Yes? The numbers are not adding. The math is not mathing. The budget is not budgeting. The bottom line is not bottoming. That one. Why are you not asleep at 3 a.m.? You know Psalms 127 says, the Lord grants sleep to those he loves. Why are you not sleeping? Why are you awake on the phone? Maybe you are drinking. Actually, in this microfinance where we work, we analyze the investor statements to understand the customer. Where do our customers take their money? I tell you, people drink. And then they take loans. And then they pay for those drinks. Chaotic. Without planning. The speaker spoke about financial health. Financial health is very linked to mental health. In fact, psychologists, therapists, counselors tell us that the highest amount of stress is linked to financial stress. Even relationship stress, that other gender does not stress you as much as financial stress. Because that other gender you will complain and say, okay, this one is just taking me here, there, everywhere, I can't, and then somebody else will tell you their story, even you, even me. Yeah, there was this buddy who took me, there was this, you will share. Itasema, itatoka. Financial stress brings shame. Nobody wants to say that their pocket has a hole, so you're dying with the shame. So the question we're asking ourselves, okay, this is what our customers want. How do we speak into their mental health? As brands, how do we speak into their mental health? Because mental health and financial health are tied. How are we speaking into the mental health of our customers? Because that's what we need to audit. What we are looking at, trust, confidence, emotional connection. He is during very difficult moments like the 3 a.m. moments. Advocacy. This is what we are looking at. Because for sure, usage is not equals to loyalty. So how much we are using our digital wallets, how much we are using the products, how much we are using is not equals to loyalty. We should be measuring these things. We should be measuring how fast we are dispensing. We should be measuring how much trust does my customer have. Because when your customer says, I trust my bank, I trust my lender, I trust my SACCO, I trust my MFI, they will say my. When someone says my, it's like my lawyer, my doctor, my. Are you, as a financial services provider, somebody's mine? Because when I trust you, I will say mine. And somebody say, come, let me take you to my, fill in the blanks. So if you're dishing out these, that is what will happen. So as we progress, these are the things we need to audit. These are the things we need to take a look at. So what are we auditing? Because we need to audit. Yeah. What are we auditing? What causes the customer Frustration. In our feedback mechanism, whatever it is, what is causing you frustration? Ask your customer. Just ask. What is causing you frustration? What is causing you anxiety? What is giving you anxiety? And it doesn't necessarily have to be related to you, the financial services provider. What is confusing you? What matters to you the most? What is wasting your time? What is absolutely wasting your time? What is causing you repeatedly? Sometimes you wonder how your financial services provider is repetitively asking you the same thing. So when we audit, let's go into the customer journey and eliminate repetitiveness. Sometimes it's because of risk. We are looking internally and we are trying to alleviate and mitigate risk. But let's look at the customer's point of view. So we need to ask. Just ask. What is countercultural? We are Africans. We have our norms. Even Africans in the diaspora have not changed after living there for a long time. So what is countercultural that we are doing? In our need to speed up, in our need to digitalize, in our need to make things shorter, faster, more efficient, sometimes we have cut out very important things. The customer sometimes is complaining very, very, very bitterly because you did not greet them. You know how much we honor greetings? We really honor greetings. And the customer will be saying, I was not greeted. And then they will give horrible feedback. It is not about the service, it is that they felt dishonored. They felt unvalued. They felt like they're not important because we didn't greet them. So in our rush to digitalize, in our rush to automate, in our rush to jump onto market share from a digital perspective, let us be very clear about what culture we shall not lose, we shall not drop, we shall not get rid of. So what's countercultural? Remember, we are doing an audit. We're doing an audit. So as we go back, these are the things we are asking ourselves. Let's not ask ourselves about the number of this, or the number of that, or the hit rate of this, or that. These are the questions we need to ask ourselves. Internally first, and then we ask our customers. So your next survey, your next customer feedback process, the next time you're talking to customers, ask them this. And we don't have to wait for a formal, sometimes we wait for a very formal process for customer experience to get feedback. No. At the end of every email, at the end of every text, at the end of every phone call, at the end of every WhatsApp conversation, at the end of every engagement face-to-face, at the end of ask the customer, is there anything that frustrates you about us? They will tell you. Is there something you feel that if we did would give you less anxiety? They will tell you. Is there something you feel is not honoring you? Is not handling you with dignity and respect? They will tell you. So this is what we need to audit, and not the digital process. Digital is digital. We will conquer. Our speaker in the morning talked about AI. Yeah, we're able to conquer many things, but the human being still remains the human being. The African still remains the African. We still remain the same. Technology changes, but we who are there in ages past, we are the same. Our heads are the same, our hearts are the same, our souls are the same, our spirits are the same, and our need for relationship and trust is the same. That bit doesn't change. Actually, what technology has done is that it has eroded trust so much that when you tell someone this was produced by AI, they're like, double check that. Are you sure? This person seems to have 4 hands. They start to look at it with a different eye. And so therefore, this is our audit. This is the audit that we are running with. This is it. And the things that we need to report on. People say that reporting on ESG, environment, social, and governance is fluff. They say it's soft thing. exactly what we need to report on. Because the more we connect at every level, the more we connect with the social, the more we connect with earth and care, the more we connect with the sustainable development goals, that is what keeps customers close to us. If your brand is showing that it is speaking directly into care, into sustainability, into the circular economy, into the blue economy, into the green economy, into the orange economy, into youth, into women, into business, into bottom of the pyramid, your customers will run after you. That's what's up. I think you have seen that with very big brands that don't have the most stable products, but we are stuck to them like it's a cult because of what they do for the community, what they do for the society and that brand. And so even as we run after digital wallets, let us audit these things and let us report on these things. So what we want to conclude by saying as we run off to lunch this afternoon, because we are talking about the war for customers' wallets, the war for digital market share. This is all we are saying. One, human-centered versus tech-centered. Customers, for sure, they compare every experience they have with the best experience they have had. They're not going to compare this circle and that circle. They're not going to compare this bank and that bank. They're not going to compare this microfinance and that one. They're not going to compare this insurance and that insurance. They're not going to compare. They are going to compare with the best experience they have ever had. How does this brand make me feel? So if as a SACCO I'm not making the customer feel some type of way, if as a lender I'm not making the customer feel some type of way, if as the bank I'm not making the customer feel some type of way, as a SACCO I'm not generating that feeling, then I'm not competing in the right space. Because products, financial products, we will innovate to no end. In fact, if you knock on this door and that door and the other door, the products are generally the same. Generally the same. Maybe a bit of tweaks here and there, but they're generally the same. But for you to connect with me at a heart level, that is not the same. For you to see me, understand me, feel me, hear me, value me, acknowledge me, and then think of a brand that does that and I say, my SACCO doesn't do this for me. No. Let me go elsewhere. So customers are comparing. They are comparing experiences. They're not comparing products and services. Two, winning customers for life requires that we design for the human being and not for tech. So we need to go back and evaluate our digital journeys. Put feelings in there and come and say, have we designed for tech or have we designed for the human being? That's of utmost importance. Number three is the future belongs to those that design around reality, human reality, and not tech possibility. So what's the human reality? What do human beings want? And remember, as human beings, we are very irrational, very emotional. You cannot understand human beings. That's why in customer experience excellence, we say that for sure, if you achieve a customer satisfaction score of 80%, you have won. You have won. You have won. You should go to the Bahamas and celebrate with your staff. If your CSAT score is above 80%, go and reflect on your tool. You are lying to yourself. Because I kid you not, satisfying human beings is very difficult. Very difficult. So if you're at 80%, you are sorry. You're sorry. If you're above 80%, please go check on your tool. There's an issue. There's an issue. There's an issue there. Check on the tool you're using. What are you asking? How are you asking it? How have you framed it? What's the languaging? How often are you administering it? To who are you administering it? What's the sample group, etc.? Human beings are not easy. So if you check the human reality right now, what do my customers want versus what can tech give me? What can AI give me? Those are great, but we must juxtapose it against what does the customer want in the here and now. And remember, our customers are becoming younger, and younger and younger. And trying to understand that younger and younger and younger customer group requires a lot of time, a lot of investment, a lot of speaking, a lot of listening, a lot of understanding, a lot of walking in their shoes. Walking in their shoes. Because as we say, 85% and below of this country is 35 years and below, right? Yeah. So we need to understand that customer. And finally, success does not belong to the most digitally savvy finance institution. Success belongs to the most empathetic financial institution. And when you have empathy, customers for sure will even forgive you when things go wrong, because they will go wrong. They will go wrong. And so when we get up and we take the mic and we stand in the middle of the podium and we have authority, because IT has authority. The person in the institution with huge authority is IT. We usually say it's the data person. The person who's the data analyst, the business analyst, the person who has control over data in the institution is very powerful, because without data we are nothing. However, data for data cannot do nothing. The IT person needs to run the reports, needs to compare and contrast, needs to develop trends, needs to run this data against this other data, etc., etc., etc. That's what we are saying. So when the person with the most authority stands in the middle of the room over here and says, stand up and walk 5 steps in any direction and stop there, please don't. Please don't. Because IT is going to tell you we need to invest in AI, we need to digitalize, we need to automate, we need to. Don't ask why, and why 5 times, right? Please turn to your neighbor and ask them, why 5 times? Why? Why? By the time you get to the 5th why, and you have put on the customer's hat, you will be creating, innovating, implementing, and sustaining what will cause you utmost success in financial services. And our last one today, before we go for lunch, this is not a war for app downloads. This is a war for heart downloads. This is not a war for app downloads. This is a war for heart downloads. May you all go forth and win the hearts of your customers, now and forevermore.
We can do better. I think that was a very good presentation. Caro, just a minute. I don't know if is somebody with a question? Yes, kindly. Let's take in a few questions. As I direct you, how we're going to.
Thank you, Carl, for the wonderful presentation. Yes. I'm just trying to balance the competition of our client space on the customer's phone.
Yes.
And the discussion we found in the morning on financial health.
Yes.
And I'm just wondering, how can the lenders now balance the financial sustainability,
yes,
with the social mission of now improving the customer's lives?
Right. I love that question. It's a question of having abundance mentality, which we need to have. When I was working for this microfinance, many times customers came to us because they wanted money. They wanted a loan. I need a loan, I need money. I need it. And when you look at the customer, the profile is okay. Their credit 5Cs is okay. They even have collateral, which is okay. They have it and it looks good. But when you ask the customer, why do you need this money? What are you looking for money for? What are you going to do with this money? How will this money help you? Have you spoken to your family about this money? Have you bounced this against somebody else? Who is your accountability partner? Where do you go to for wisdom? Is this money really the money that you need before we lend you. Many times people came for money and we didn't give them the money. Because money can collapse you. If you take money that you have not planned for, you can go and collapse with that money. And then your collateral damage will take your family in that mess. So if we are operating from the heart, and if we are having an abundance mentality that even if I don't lend to this one, because when you lend to money, it's good, interest is good, you make money from there. So that's how you make money. And the company is sustainable. Yeah, but you can say no. You can say no because you're thinking about the future of this person. And the person you have refused to lend money will go back and come back and say, come, let me take you to where they will ask you hard questions. Maswali clinic. Come, let me take you to this lender who cares. And it's not just here to take your money and get interest out of you. And so it is possible to balance financial health of the individual and financial health of the company because it grows. People bring people. People bring people. Because for sure, let's say your customer base is, say, who shall I ask? Who is next to me? This table, who's sitting on this table? Your which company? Which circle? Thai circle. How many customers do you have? Roughly? Numbers? 100,000. All right. Let's use them as an example, right? Okay. They have 100,000 customers in the customer database. When you have been kind and looked at from an empathetic view the financial health of one customer, and then in your circle you tell your customer, one customer, just bring one, only one, you will soon have 200,000 customers. Because it is possible for me to bring a customer with my heart and they will believe me and they will not go shopping anywhere else. One customer to bring one customer. We're not talking about 20. We're not talking about me standing in a room full of 80 people like this and bringing all of you because it's possible, right? Just one to bring one. That is the power of operating from the customer's heart. They will bring another customer. You will not need a billboard. You will not need a marketing budget. You will double your customer base. If you double your customer base, the bottom line is good, right? Very good. And it comes from handling customers with a heart. All right? I have answered your question. I think we are good now. We can go for lunch.
Is there another burning one? Ama mtauliza tukiwa lunch. Okay, thank you so much. That's a very massive round of applause. Thank you so much, Carol. That was interesting. Silvio. So right now we want to break for lunch, and lunch will be served on the second floor. So we will go and use the lifts. There are also some other lifts on this side, all the way to second floor. Now, for you to access lunch, you need a meal voucher. I have the meal vouchers, so I'll be standing there, and everyone will be given a meal voucher. Then it's exactly, what time is it? 1:30. So we meet here at 2:30. Lunch is 1 full hour, so that you can also network. So enjoy your lunch. Let's meet at 1:30. Msisahau second floor, sawa?
Yes.